Yeah, good afternoon, everyone. I am C. Chandraprakash Bhutra, the moderator of this webinar. We are delegated to welcome you all in the webinar, which is being organized by a continuous professional education committee of ICI. This webinar will benefit the members in the large, and it is a continuous series. It started from 6th of October to 17th of October every day on 12 p.m. to 2 p.m. We request you to please block your calendar for the upcoming webinars of this committee. It is my pleasure uh, to moderate the 51st webinar on practical aspects
टैग
of tax
टीम
audit.
आवाज कहाँ से आ रही है? दीपक जी दिखाओ ना। ये उतरा जी बोलिए।
So it is my pleasure to moderate the 51st webinar on practical aspects of tax audit and cost 2021, 23 and 31 and accounting standards 145. We will start the webinar, but let me brief introduce about the CP committee. The profession of chartered accountancy is growing leaps and bounds, and its phenomenal growth has brought the profession at the forefront. Today, our professionals has acquired an indisciplined position in business and economy. ICI continuously aims to developing knowledge age for its members to meet the criteria of the society. To achieve the objective, the CPE committee of ICI has been continuously striving for perfection, integrity, and knowledge, which made the word chartered accountant synonymous with excellence in services. In the direction, the CPE committee has always been proactive in the emerging needs to its member, enabling them to accurate contemporary knowledge and skill to face the challenges effectively by organizing CP programs and educate opportunities. The program for the evening is as follows. The first topic will be on tax audit costs 2021, 23, and 31. And the second topic will be on accounting standards 1, 4, and 5. And the final session will be on practical aspects of tax audit. Our eliminated speakers will talk about the above mentioned topics and in the professional interest. Let me first welcome our Vice Chairman of the committee, CA Vishnuji, Vishnu Prakash Agrawalji. I am very fortunate that he is belonging to the same place from where I am. He is belonging to Parli only. CA Vishnu Kumar Agrawal is a Central Council member of ICI for the term 2025 to 2029. He currently remains the Vice Chairman of the CP Committee and the Directors Committee of ICI. Additionally, he is an esteemed member of several other key committees of ICI. With over 2 decades of experience, he is specialized in income tax matter and has also authorized the and also author of the book Landmark Judgment of Income Tax. Beyond the professional commitments, C.A. Vishnuji is actively involved in social services and community incentives. His professional acumen, leadership role, and dedication to both the profession and society make him a respected figure in the accounting and taxation domain. So I welcome C.A. Vishnuji Agrawal for his welcome note.
Very good morning, our own chairman of the CP committee, C.S. Satish Gupta ji from Jaipur, my another chairman in the direct tax committee, and today's speaker on this particular webinar, C.A. Piyush Chhadir ji from my own city, Mumbai. Today's moderator, C.A. Chandraprakash Bhutra ji from my native place, Pali. So it is a very good combination today for me because my two chairmen are here and my moderator is from my native place. So today is my privilege to giving opening remarks in this particular webinar. Friends, for what we are doing with the CP committee, since my CP committee chairman is here, so I will not apprise more about the CP committee. And I am also vice chairman of the directors committee also. So benefit of all the members because my chairman is here. So I just elaborate what we are doing under the directors committee of the ICI. Friends, just we have came out with the our Income Tax Act 2025 with the rupees of only 500 rupees, including the shipping charges. So I request each one of you take the maximum benefit of the Income Tax Act 2025 because all the publications, all the other publications houses, they are selling the 2000 rupees and 2500 rupees. So myself and our chairman CFU Chajirji has thought that why we should not print our Income Tax Act 2025 by the Institute of the Chartered Accountants of India, and we have printed more than 2000 copies for the benefit of our members across the country. At the same time, friends, we have also came out with the guidance note of 44 AV. So I request each one of you the 44 AV guidance note is posted on our website. So I request each one of you kindly take the maximum benefit while doing your tax audit. Friends, we have also came out with the checklist of all the ITR forms 1 to 7 to take again the benefit of all the checklist of the ITR forms. Friends, today we have privilege to see Piyush Chhajirji, very good, knowledgeable person, knowledgeable Central Council member, senior Central Council member from Mumbai. He will speak on the tax audit, tax audit closes 2021, 23 and 31. And again, we have with us past President C. Amarjit Chopra ji, who will speak on the accounting standard 1, 4, and 5. And again, our Central Council member C. A. Pramod Jain will speak about the practical aspect of the tax audit. So today's webinar, our chairman Satish Gupta ji has structured such in a way that my each and every member will be benefit with the tax audit also, along with all the accounting standards. And friends, from last 2 days, we are again continuing this type of the webinar for the benefit of our each and every member. Our chairman has always thought that under the CP committee, we will reach out with the last corner of the members in our country. So we have decided that we are only our 1 or 2 members are resigning, and they have their office. We will also reach out to that member also. So he will be again benefited with each and every activity of the CP committee. With these words, because time is limited, I request our moderator to introduce our chairman, Satish Gupta. Thank you, friends.
Thank you very much, sir, for your welcome words. Now I like to introduce our CP committee chairman, C.S. Satish Gupta, sir. C.S. Satish Gupta, sir, is presently securing the post of the chairman of Committee of Professional Education along with chairman of UDIN, and he is also vice chairman of Committee of Members in Practice. He previously served as council member for the term of 2019 to 2022. He is a renowned speaker and author specializing in income tax matters, assessment, surveys, search, and professional development topics like goal setting and career planning. So it is my immense pleasure to invite the sir for his welcome words.
Thank you, CP. Thanks a lot. My dear friend Piyush Chhajirji, I believe that he's a wonderful person. As I started this year in council under his leadership, when we met with the select committee of 31 member of parliaments in the Lok Sabha and to represent the ICI on various issues of income tax bill 2025, and that I can just say that under his leadership, the work done by the DTC was recognized by the not only by the select committee but also by the parliament, and various suggestions made by all of us were taken care of while drafting the Income Tax Act 2025. So welcome, my dear brother Piyush Ajay ji, in this webinar, and My brother Vishnu Bhai, to whom I feel that we together one, we are not two, we are 11, 1 plus 1 are 11, and we are working great in this committee. That how can we reach to the last member of the remotest corner of the country with the CP program. And my dear CP, who is from Pali, but luckily we all four belongs to Rajasthan. And the another speaker, Pramod Jain, is also is from Rajasthan. So out of six today, we are we five are from Rajasthan. So something Rajasthan is shining today in this webinar. And the team CP, Deepak, and Gindiji, and team Tech, and my dear friends who in a very large number attending this webinar. Welcome to each one of you, and thank you for attending the webinar. Friends, today's session in this webinar are being kept by keeping in mind that this is the month of audit, and we should refresh ourselves with certain classes of tax audit, with certain classes of standards on auditing, with certain classes of the accounting standard. So this is the series which we are running for 10 days continuously on different classes and different standard on auditing and accounting standards. So in today's session, my brother Piyush Hajedji is going to take 20, 21, 27, and 31 class number classes of the 3CD reports, and all are very important, my dear friend. 31 has got some new changes this year with a drop down facility that you can mention exact mode of the payment or the receipt. So you must understand those very carefully. And the clause 20 is also important, where any bonus or commission has been paid to the employees. And 21 is always it is important since beginning of the tax audit, that in 1984, that inadmissible expenditure, whether the expenditure capital or personal or some penalties there. So we all these classes being taken up by Piyush Hajedji are very important, my dear friends. And after his deliberations, I can assure you, I can guarantee you that you will learn something by unlearning several things which you were keeping in mind as of now. So you will definitely love to listen Pius Bhai. Thereafter, we will have the opportunity to listen our past president, a very, I can say, tycoon of the profession, Amarjit Chopra ji, and he is going to take up that accounting standards 1 and 4 and 5, very important, my dear friends, because how can we present the accounts has always been important, but nowadays it has become more important. So I think we should track all the accounting standards and standard auditing whenever we sign any document. And Pramod Jain sir will take the important topics, or I can say critical stages of the tax audit report. So all the three sessions are going to be very important. And as rightly told by the moderator, this is the 51st webinar of the CP committee this year. So you can understand that how deep we are trying to reach out the last member of the profession who is residing in the remotest corner of the country. So this is something I believe that wonderful. And something about the CPA committee, friends, we are coming up with a real-time attendance basis, real-time CP credit basis. I think not in October, if not in October, by November end, we will come up with the new portal where any CP credit will be available on real-time basis for the time you attend that particular program. So I think you must welcome, because it is now 20 years old CP credit system, and now we are all well matured. In India, 18 years of age is allowed for the voting. In UK, I was reading that they are allowing 16 years of age for voting. So we are 20 years old in the CP credit system. So now I think we should be so matured that we welcome this stage of real-time credit system in the CP credit. And friends, something about the UDIN. We have come up with UDIN three important things this year. Number one, with the I would like to quote my Piyush Bhai also, that from 1 for 2026, the Direct Tax Committee has mandated that partner or the member can sign only 60 tax audits. If a firm has four partners, 240 audits the firm can sign, but one partner can sign only 60 audits. Now that thing we have also incorporated in the UDIN system. Now there will be no UDIN generation on the 61st tax audit. So we have brought this one change. Another important change which we have brought in the UDIN is that the preceding auditor can know the name of succeeding auditor. Just to ensure that his fees are if not paid, he can contact the succeeding auditor, or we can check that whether communication with the previous auditor is there or not. We can check whether any fees outstanding of the previous auditor has been paid or not. So this new thing which we have brought this time in the UDIN. And third thing, which is very important, friends, UDIN is asking each one of you certain thing whether your report has some opinion what you are signing. If it is having an opinion means, my dear friends, there are some certificates which don't require opinion on the financial statement which we can submit. If you are attesting financial statement, then that particular requirement of UDIN is necessary. So suppose you are signing a balance sheet or financial statement, and if you have an opinion whether clean or modified, you have to go for that particular clause. If the report is clean, you need not to move further. If written your opinion is modified, then you have to decide whether it is qualified, whether it is disclaimer, or whether it is adverse opinion. Or if there are certain other requirements that CAM and EOM and other matter for the corporate assessees. So kindly don't hesitate, and we are not asking that what report you have made. We are simply asking that yes, if it is qualified, say yes, or if it not qualified, forget it. So it is only for the research purposes. It is only for the data purposes, so we can represent before the government whenever it is needed. And friends, these particular information will never be disclosed to anybody. This is not that your verify even cannot see these information. So come forward and go for the quality work. And believe me, friend, this is going to be a game changer for the audit profession. Third one thing I would simply address about the CMP committee, friends, where I am vice chairman. In CMP committee, I am having a charge of the member benefits. So we have brought this year the an unsecured loan facility without collateral from SDFC Bank at the rate of 10.6% reducing interest, which is very competitive. If we see the other companies like private lenders, those are charging 13% or odd percentage. It is only 10.60 with a very minimum processing charges. We have also come with a term loan. Overdraft limit with the same SDFC Bank. We are coming up with a very good credit card by the AU Bank, a private bank. The AU Bank is going to provide the lounges and lifetime free, no entry, no joining, no annual fees. And apart from this, every member once in a life, once in his professional career, will get 25% discount on the renewal fees payable to the ICI, and he can take any time that particular discount. And we are working on several other benefits for our members, so they can feel good that yes, whatever fees you paid to the ICI, we will try that being reimbursed to you by all these type of CMP benefits. So I just want that give your suggestions, give your feedback, feel free to talk. We all are there, and I can say you that Vishnu Bhai and Piyush Bhai and all other council colleagues are always 24/7. They are working 24/7. I repeat, all the council colleagues are working 24/7 for the betterment of profession and fraternity. And I again welcome Piyush Bhai. And I don't want to come in between you and the Piyush Bhai right now. Thank you very much. Thanks a lot. Again, welcome to Piyush Bhai and other dignitaries. Thanks a lot. All the best. Jai Bharat, Jai Aise.
Thank you so much,
Over
sir.
to CP.
Thank you so much, sir, for your welcome note. Now, it is my privilege to introduce our first speaker, uh, Shri Piyushji Chajer. He is he is having a 25 years of professional experience, and he is a senior partner at a firm in Mumbai with a foundation with a taxation and with a specialization in taxation litigation and advisory. He has been a council member of the Institute of Chartered Accountants for 2 consecutive terms for 2025 to 29 and 2022 to 25. He is currently the chairman of Direct Tax Committee and vice chairman of the Expert Advisory Committee of ICAI. Along with the committees, he is benefiting the ICAI with the international collaborations also. He is a member of Working Committee of ASEAN Federation of Accountants, Technical Advisory on IAASB, and member of SAFA Committee on SAFA Committee. So, may I hand over the podium to Piyush sir without much time to enhance his deliberation on clause 21, 20, 21, 23, and 31. Over to you, Piyush.
Very good afternoon to all of you. Am I audible, CP? Yes. So, thank you very much, Chandraprakash Bhuttadaji, who's from Pali. Again, I'm also from Pali. So, same place. Thank you for your wonderful introductions. Chairman Satish Guptaji from Jaipur, whom we heard, and who has brought out his initiatives. Good work been done in CP committee. My compliments to him, and my compliments specifically to Chairman and Vice Chairman C. Vishnu Agarwal for holding this 51st program webinar in the time of 6 months span. It's a really great. G. Goyalji, Secretary to the CP committee, Deepak Kishore, and all other tech team of the CP, and the members who have joined this afternoon. And I do understand it's an audit season and a great initiative by the CP committee for doing the continuous webinars. And I've been told it has started on 5th October, which will continue up to 14th September. And a beautiful line of speakers today in store when you would be hearing, I'm sure, none less than Amarjit Chopraji, who's been my mentor also, who would be speaking on accounting standards, I think. So that would be a wonderful experience. And Pramod Jain himself. Of course, when it comes to a direct tax, and in fact, your chairman and vice chairman, though they are CP committee chairman and vice chairman, Vishnu Agarwalji is also vice chairman of direct tax committee, and both of themselves are authority in the direct tax. And obviously, I think so they could also speak very well on any of the subjects of this particular tax audit which we are talking about. But of course, I thought today I'll try to interact on the CP platform also. I've been interacting on the as a chairman of direct tax committee also. Before I go to my important 4 clauses which has been allotted to me, a very important area which I would like to say, I'm in the Institute of Chartered Accountants of India today in Delhi. And today morning, 10 o'clock, we had a meeting with the Niti Aayog. I am part of tax consultative group which is formed by Niti Aayog for purpose of recommending tax reforms to the government of India. And myself and the president of the Institute ICI had gone to that meeting. And under that meeting, of course, today another document, tax paper 2, has been released, whereby Niti Aayog is suggesting to the government to decriminalize the Income Tax Act. When I talk of Income Tax Act, obviously it's an Income Tax Act 2025. There are a lot of criminal provisions as far as Income Tax Act 1961 is concerned, which has been already reduced in Income Tax Act 2025. But further suggestions have gone by that tax consultative group through Niti Aayog, of which I was a member of that particular group. And we have suggested that the criminalization provision, which is 37 even today in the Income Tax Act 2025, should be brought down to 6 only. The rest all should be removed. And out of 37, I would not say removed. In the 17, it should be partial relief should be granted. And the criminal proceedings only should be taken only in very specific cases where there are malified intentions or falsification of books or falsifications of documents, etc. Not in all cases which can be termed as a procedural lapses, technical lapses. Just take an example. I had to file a tax return on a particular date, or knowingly, unknowingly, I verified a tax return wrongly. All this should not lead to a prosecution. I believe because we had already, in fact, Institute through its Direct Tax Committee had already suggested this, and therefore from Income Tax Act 1961 to Tax 25, you would find that a lot of suggestions have been accepted and decriminalization has been started. But I believe in Income Tax Act 2025, before it comes into the force from 1st April 2026, again, suggestions are being sought because it will get amended through a budget which is expected on 1st February 2026. For that purpose, the suggestions has been sent by Niti Aayog. I was part of that. Even the institute, you may be aware, you would have received an emails that for giving your suggestions on the pre-budget memorandum. which will be sent to the department, to the revenue, for incorporating those suggestions in the Income Tax Act 2025. Please do give your suggestions. It's very important. Third, we are also working upon the new tax forms and new ITRs. It is from two aspects. Of course, new tax forms, when I say that is Form 3CD, which will have a new number coming under Income Tax Act 2025. Our suggestions from the institute would be going in the coming week. At the same time, the new ITRs for the assessment year 26-27, that is financial year 25-26, as well as for the new, under the new Income Tax Act also is underway. And at both the places, obviously, institute has been represented and they have been approached by the department from the institute, by the department to the institute, seeking suggestions thereon. So if any of the members who are listening to me today, if you have any suggestions on changes to be made in IDEA, you have already had an experience of IDEA 1 to 7 and you have done certain filings as of now today. So of course that report has to be finalized before 15th of November for giving all the suggestions in this regard. I would request if anybody has any suggestions, existing forms, please do write to the CPE committee. You may write to DTC committee, you may write to any council member. I can only tell you that each and every suggestion of the member which comes is being considered by the Institute of Chartered Accountants of India, and definitely if the committee feels appropriate, they are also escalated, put forth to the appropriate bodies, and they are being considered well also at that point of time. I know that obviously today we are here to discuss more of the tax audit. I'm going to put my presentation on the screen. Of course, this is a presentation only on the clauses because I come from myself from a tax background. And personally, this may include certain presentations, certain judgments, which I may just skip it. And I'll just try to concentrate because I have a limited time. And I know there is a 1 o'clock session where we have to hear the past president, say Amarjit Chopraji, who would be on joining at around 1 o'clock, before 1 o'clock, 5 minutes. I'll try to wind up this session at 12:55. So roughly I have 25 minutes to speak on a technical subject. And that is the 4 clauses which I will have to speak. I'll try to cover up and try to bring out more responsibility from a tax auditor's perspective rather than the judgments. Of course, my slide would look that there are certain judgments which I'll skip when I'm just going through those slides. But important area is what an auditor is expected under that particular clause. I'll try to bring out my experience, my perspective, my personal views, obviously. Before I go to my presentation, only one thing, please do look at our guidance note issued by the Institute of Chartered Accountants. For any reporting under any clause of Form 3CD, 3CB, 3CA, please do follow that guidance. So the level at which the guidance note has been regarded by the various judiciaries is very high. Guidance note stands at a very high pedestal when it comes to authority attached to the documents issued by the ICI. And therefore, my request to all the members who are hearing me, please do follow the guidance note. You may have a different view with what is written in the guidance note, but as I always say, that you may not agree with what Supreme Court is saying, but of course, judgment rendered by the Supreme Court is final and binding. Similarly, any publications, any guidance note issued by the Institute of Chartered Accountants of India in relation to accounting, in relation to auditing, are final and is as good as mandatory. Guidance note is mandatory. You are expected to follow that. In case you are not able to follow that, then you will have to document it well, that what are the other alternate procedures which you have followed and why you have not followed the guidance note. It is there to ring fence you. If you have been put to question tomorrow that whether you have discharged your responsibilities as an auditor adequately or not, you can always fall upon the guidance note. Yes, I have followed the procedures while reporting under this clause, while giving my opinion in Form 3CB or 3CD or 3CA, 3CB, and I have followed the guidance note issued by the Institute, and definitely that will ring fence you against the questions put by the various authorities. So keeping this in mind, yes, tax audit, of course, whenever I talk, even the sake of repetition, all the members should know tax audit was introduced somewhere in 84, 85, and the idea of the tax audit was that the scrutiny, which was 100% of the cases were scrutinized. Whatever return you used to file at that moment of time was selected for the scrutiny. So they wanted to bring down the percentage of the scrutiny. So the only alternate available was that rely upon certain experts who can certify certain provisions of the law, that how it would be reported, whether the compliance has been done into that extent or not, whether there would be any allowance or disallowance to that extent. And therefore, it becomes very important. The main objective of tax audit is to draw the correct computation of income, obviously, and look into it. When you want to draw correct computation, obviously, the review of accounts is involved, because you are certifying financial statements which are annexed to your tax audit, and therefore, you ensure that the examination or review of accounts is happening correctly, number one. Number two, proper tax provisions are implemented and the compliance has been done. Third, all the standards issued by the institute and binding based on the size of that particular entity are followed while preparation of the financial statements. Please do keep that in mind. The ultimate objective remains that it enables the tax audit for verification of the return. That's the important. And therefore, I always say, as a tax auditor, you have a dual responsibility as an auditor of the financial statements also, and auditor but for the tax audit also. So you have to have a knowledge of your accounting standards also, as well as taxation also when you are doing the tax audit. And therefore, obviously, the trust which has been placed upon the chartered accountants, we needs to uphold that. We do know that tax audit is only available to a chartered accountants. The section 288 and now in the new act also, whatever perimeter area has been continued. So chartered accountants would be carrying out the tax audit. It is that important reporting responsibility which has been put on us as a chartered accountant. We should discharge it very purposefully. The purpose for which it has been put on us should be achieved. That's more important. And it should not happen that we are just giving a disclaimers or we are just giving an observation. Our idea should be to extract, verify more and more reporting from the SSEs and get it reported in Form 3CB. And then you give a certification in 3C and 3CB. That's what an idea is about. Coming to very specific clauses, I'll try to take 5-7 minutes of broadly what does clause 20, 21, clause 23 and clause 31 includes basically. So as you know, clause 20 is a very specific, it deals with any sum payable to employee as a bonus, section 36(1)(2). If you read 36(1)(2), the SSE would be allowed a deduction for bonus or commission paid to an employee is allowable only if such payment relates exclusively to services rendered by them and is not in nature of profit or dividend and distribution. So you need to understand, it's very important, I'm telling you. Sometimes it happens in a private limited company. You have 2 directors, only those are the employees and those are the only shareholders. So ultimately, as a matter of a tax planning, because there is a double taxation involved, company pays tax, and hereafter when you distribute a dividend, the individual also pays a tax, that is shareholder and director. So sometimes a person may try to not distribute any dividend, but only give bonuses. And the bonuses to the director shareholders is very high. It's not comparable when compared to the other employees. So for an example, when it comes to another employees, I'm paying a statutory bonus of 8%. Or maybe 12%, whatever it is, depending upon the state which you belong to, or maybe another 20%. But when it comes to a director, somebody would be paying 100% bonus. So 36(1)(2) says that if the employee, the director employee or a shareholder who is also a shareholder and who is the owner of the company in that way, if he has been given a bonus which otherwise would have been payable as a profit or dividend distribution. So for an example, I'm paying a handsome bonus of 100% to my shareholders, who are the 2 shareholders and who are director employees also. Whereas to all the employees, I'm only paying a 10% of the bonus. And you are not able to actually justify that why, what was the additional services which the top management could provide, which other employees have not done when it comes to the growth of that particular entity or particular SSE. You need to report over here. I'm sure hardly any reporting is happening over there, but there are judgments, I would tell you, in this regard, wherein tribunals have held that company is not paying dividend for 5 years, 6 years. And suddenly they are paying bonuses, handsome bonuses. So this is nothing but it is an akin to a profit or a dividend distribution. So I will disallow this particular bonus. So that tax has already been paid by an individual in his hands when it comes as a bonus under the head salary. But it is disallowed under section 36(1)(2) because it has been treated as akin to distribution of profit or dividend. So the auditor has to be very careful and has to look into the whole given, that what is the experience, whether the dividend has been declared over a period of time or not, whether the bonuses are paid which are comparable to other employees or not, and then look into it and actually report under this. Of course, there is a chart which I said how it has to be reported. Of course, clause 20 has a second leg also, which deals with 3615. I am not going very detailed into it. It is in regard to contribution received from the employees. You all know what reporting has to be done. You have to give the nature of the fund, some received from the employees, due date of the payment, actual amount paid, actual date of payment to the concerned authority. It's a reporting area. But if there is a delay happening, now there is already a Supreme Court judgment which says if the employee's contribution which has been recovered and which has not been paid in time, you have to disallow in the computation also. So if the employee's contribution recovered in month of March, and for an example, the due date is example 15th April, if you have not paid before 15th April, it is a permanent disallowance. So the assessee may suffer a permanent disallowance, unlike 40A1A, 43B, which may be disallowed in the year when it has not been paid, but on actual payment, it is disallowed. This is a permanent disallowance. Once it is delayed, it is delayed. It does not also give you a benefit within the year also. So if the fair payment which was due on 15th of March, for an example, if it is not paid on 15th March, it's permanently disallowed, irrespective it has been paid before 31st of March. So you need to keep it in mind. Obviously, this reporting is another requirement. So clause 22, very two things in relation to employees: bonus, PF, ESIC. You all are aware. I'm not going well into detail of that. Clause 21. One is the very bigger clause, because you have many sub clauses under that. You have A, B, C, D. It goes up to G and H. What does clause 21 primarily deals with? It says that if you see the heading, of course, there is certain change which has happened in the Form 3CD, and that heading has been removed. But according to me, clause 21 reporting involves only of the certain nature of expenditure listed in my slide. You can see from item number 1 to 8, which have been debited to profit and loss account, and which are in nature which otherwise should not have been debited. Number one, maybe capital expenditure or revenue, or which are in the nature of a particular area, particular nature as given in 1 to 8. And obviously, department wants to know that whether such nature of expenditure has been incurred, which has been debited to P&L, so they could obviously compare it with the computation, whether the disallowance happens or not. Please mind it, one more. In certain cases which are listed on my slide, clause 1 to 8, only reporting over here does not mean there would be a disallowance. It's not necessary. When I go ahead, I'll let you know. Now, let's take an example of a capital expenditure. So, if there is an amount which expenditure has been incurred, which is in nature of capital expenditure, but you have debited to profit and loss. Ideally, a capital expenditure should be capitalized. It should go to the balance sheet. It should not form part of your profit and loss account. But if the auditor feels the amounts, let's take an example, there is a huge appreciation which has been happened. Technically, ideally, auditor is of the opinion that this is a capital expenditure and it should have been capitalized. But it has been debited to profit and loss account, you should report over here. Obviously, another question may arise that if it was in nature of capital, why it has been debited to revenue, and what is the responsibility of the statutory auditor? Here I'm discussing reporting from a tax auditor's perspective. There could be two different views. A statutory auditor may have certified a financial statement, presuming that there are two different auditors. If you are one auditor, obviously, I am sure you will not certify those financial statements, or even if you certify, you will give an adequate qualification and report in Form 3CD also. But supposing you have a different statutory auditor and tax auditor is different, a statutory auditor has taken a view that this is a revenue expenditure, and that's why I would debit to P&L. But if you are of the view that this is a capital expenditure, you may have to report it over here and give it in the observation that the view of the auditors may not. So it's not necessary that you may agree with what is stated in the financial statement. But if you are the common auditor and if you do not agree with the view taken by the management in the financial statements, you may have to qualify in the financial statements also based on the materiality, and also report it over here. When it comes to reporting over here, there's no question of materiality. Even if it is a 1 rupee, of course, capital expenditure cannot be 1 rupee. But even if it's a 5,000 rupees, which you believe it's a nature of capital expenditure, and ideally it should have been capitalized, you may report it over here. So I know in my next slide, you will find what are the important tests which you have to apply. I'll try to tell CP committee if this particular test which is appearing, you may be circulated amongst the members who are attending. I think so that will help. But as an auditor, you will always have to test to determine that whether that expenditure is giving you any advantage of enduring benefit, whether it is related to fixed capital or fixed asset, whether it relates to basic framework of the assets, or it is expenditure to acquire intangible assets. These are all important questions which are relevant to determine whether it's a capital expenditure, which will help you in reporting. Other slides, I'm just skipping it because, again, it will expenditure considering the time. My idea is to bring out what is the reporting requirement. So coming to another question is in relation to 21B, if you see the very first slide, I'll go to the very first chart itself. Personal expenditure. Any expenditure which is in your opinion, which is in nature of personal expenditure, and it is not for the purpose of the business, the assessing needs to be reported over here. Again, as I said, ideally, this clause 21 is such that if such expenditures have been incurred, it may not form part of your P&L itself. Let's take an example, but if it is a private limited company, then obviously it will form part of P&L. But if it's non-corporate assessing, you may actually debit it to the capital account if your opinion is that, or you may advise your client or whosoever is certifying financial statement that why you are debiting to P&L, you may look into a capital expenditure. But if those expenditure has been incurred by the company, obviously company, you cannot debit it to capital. It has to go through P&L, and the reporting over here should happen. I have seen capital expenditure, personal expenditure, when we review the tax audit report also, hardly such clauses are generally being used. People do not report. Of course, when it comes to a corporate entity, there are judgments to effect which says from a perspective of a company that can never be anything personal. Company is a corporate entity. What do you mean by a personal expenditure? Personal expenditure can be qua individual, can be qua a firm also to that matter, because it's nothing but an aggregation of an individuals. There are judgments to that extent. But when it comes to a private limited company, it's a question of personal expenditure. There is nothing personal for the company. Whatever is incurred for the purpose of business. At the most, if I've incurred as a personal expenditure for some director's benefit, which does not give any benefit to the business, it may be taxed in the hands of a director as a perquisite or maybe any other section which is applicable. But that cannot be a personal expenditure from private limited company. So auditor may have to look into those aspects and then report over here. Of course, third, advertisement expenditure in souvenir, brochures, tracts, pamphlets. That is the reporting. If you have incurred any advertisement expenditure, please do report over here. Fourth, expenditure incurred at clubs, bin entrance fees and subscriptions, been cost for club services and facilities used. Again, this is the reporting requirement. I am not stating you are reporting over here. That does means that I will also disallow. Sometimes you may be wearing two heads. You are also being a tax auditor and your firm, some other partner is filing the return for him. So if I am reporting over here as a cost of club and services, maybe an admission fee, which may be 10 lakh rupees sometimes, which may be an higher, which may be a material amount, but it may not be disallowed. For that, you may have to refer to Income Tax Act. You may have to refer to a judicial precedents available in as of today. For an example, I can tell you for the clubs, if you are paying an entrance fee of 10 lakhs also from a private limited company, there are judgments which says it cannot be disallowed. It's nothing personal. It cannot be disallowed under Section 37(1). It has been paid for the purpose of the business. Yes, directors are required to visit to the clubs where they develop businesses. And therefore, it has been allowed under 37(1). So, of course, reporting here does not automatically lead to a disallowance. But as an auditor, you may have to verify all the ledgers, verify all the expenses, and report in response of 4 and 5. Similarly, item number 6, 7, and 8 on my slides deal with expenditure by way of penalty or fine or for violation of any law, or expenditure which is not covered above, expenditure incurred for purpose which is offense or prohibited by law. There is also amendment which have come. Now you have to also report any fee paid for compounding any particular offense or so and so forth. And the 6, 7, 8 has been merged into one particular section. Any expenditure in such nature, you will have to report it over here. Please keep it in mind. And expectation from the auditor is that he verifies each and every P&L to that extent. Clause 21, of course, there are many other things. I'm just trying to now move to my another clause number 23, which is very important. which deals with 40A1A. You would see on my screen, I'm moving a little faster, but I'm coming to now section 40A, clause 21B. If you see, you have to report here disallowance under section 40A. So there may be two reporting when it comes to a TDS. If there is a violation of TDS, you are already reporting in respect in other clauses stating that what is the violation, whether there is a delay payment, but where there is actually results into a disallowance under 40A1A for non-payment of TDS within the time after deducting or non-deduction of TDS at all, you will have to make a reporting of the payment. In fact, we are trying to make a suggestion in the revised Form 3CD also, because when you actually make a payment in the subsequent year and it is allowable in the subsequent year, there is no reporting available today in the Form 3CD. I was just discussing in tax committee last time also. I believe we'll try to make these suggestions. If it accepted, I'm sure it would become a more purposeful reporting in the subsequent years where auditor can certify that yes, these amounts were reported in the previous year. It were actually disallowed, but now it has been paid in the current financial year and therefore allowable. So this deals with A and B, details of payment on which tax is not deducted. 2 is details of payment on which tax has been deducted but has not been paid during the previous year or in subsequent year before the expiry of time prescribed under section 200. There is another clause with, which is in subclause 2 is referred to as payment to resident, referred to in subclause 1A. And the second is again repetition. So I'll just go to, there are other FPTs, wealth tax, royalty, which is not most of applicable. So I'm going that. Item number 621B deals with salary payable outside India to a non-resident without TDS. The reporting will happen under there. Then very most important thing which I would like to bring out and which members should note. Let's take an example. I've paid certain amount and I'm not deducted TDS. Whether the reporting will happen under here. The reporting and the disallowance happens only in the case of disallowance. We are reporting under clause 21. Otherwise, you need not report it if there is no disallowance. And for that matter, you should refer to the section 40 subclause A, which says that if you are not in an assessee in default, there won't be any disallowance. To prove that the recipient of that amount has actually paid tax thereon. So it comes and says that yes, I have paid this amount, I have not deducted TDS. You may report into a non-compliance of chapter 17B, non-compliance of TDS provisions under that particular clause. Disallowed if is able to justify and give me a certificate in Form 26A stating that the recipient has actually paid the amount income and paid the tax. Maximum you would be liable to pay an interest under section 2011, but you would not be treated as assessee in default. So once you are not an assessee in default, section 40 subclause A will not apply. I'm not going into other aspects of 48. There are many other aspects. How much disallowance? You all know 30% of the amount has to. As an auditor, it becomes very important because it's a wide section. And this is again related to a chapter 17B. When you are examining, when you are doing an audit of your property, obviously you are expected to know all the provisions of TDS. You have to examine where are the TDS was applicable, how much is deducted, how much is not deducted. Let us take an is a change of rate. Instead of 2%, you have deducted 1% or vice versa. It may be a short deduction at some point of time. You may still report in 17B, but no disallowance will happen. There are judgments to that effect. So you need to keep this thing in mind when you are reporting in clause 21. Again, there are various judgments, how it can be invoked, whether it applies to assessing in default, but now it's more or less well laid down and there's no question, I think so, or a dispute. Certain issues also, whether the 40A1A would be applicable where income is declared under 40AD, ADA. Obviously, when you're declaring income under 40AD, 40A, you as a tax auditor, you are not an issue, but I'm just trying to skip this. What tax auditor must do, very important. Tax auditor should obtain in writing from assessing the detailed profit and loss, check for actual remittance made by overseas by assessee during relevant year, check whether tax is deducted or not, reliance upon legal opinion or certificates from CA have been made in case of NRI, because you may have access to 15CB if not issued by yourself, somebody else. You may look into it. It does not mean that a 50 non-requirement of TDS, and you may not have a different opinion or different legal opinion. So you may have to look into that particular transactions also. That's the subclause C of again, which deals with disallowance of 40B in regard to interest remuneration paid to partners. You have to report it over, you have to give the calculation, and you have to ensure that remuneration is been paid to all the working partners. It's in accordance, and it does not pertain to a prior period or the date of the partnership. You need to ensure that, and then based on that, you need to give working if any disallowance is happening to that. Because I have next 5 minutes only, I would move to section clause 31 actually, which is very important change which has come, and I'm going on that. 23 and of course clause 23 is in regard to 48(2)B payment, where you have to report payments to a specified who are the persons covered under the section 48(2)B, and you have to give details of the payment. That's all, nothing more than that. If it is an excessive or reasonable, what as an auditor of a guidance note states is that whenever the payments have been made to the persons covered under section 40A subclause 2 subclause B, please do look into it whether it is covered under 48(2)B or not first. Because the definition of relative is different than the persons covered under 48(2)B. Definition of relative or the associate enterprises in the, so everything is different. You need to independently examine that 48(2)B section, who are the persons covered, and if those persons are covered, and if any payments is out here, no disallowance only because you have reported over. It's only an information clause. That's all, nothing more than that. And that's why I said whether you have to go into the payments, no. That's all. The nature of reporting is very clear in this, and I think so it's more or less well settled now. Of course, this was a question which I raised, whether auditor has to quantify related party person is unreasonable or excessive. The cost entity. Very important clause 31 changes have come. I'm just clause 31, which deals with section 269 SS, ST, and T. A very important change has come, which was mentioned by the Chairman CP committee in the initial. Also, what did that say actually? What does clause 269 SS and ST is in regard to? That obviously you should not make a payment or the acceptance payment of a loan or the specified amount or beyond a particular limit, if it is happening by a manner other than account pay check or otherwise. So if he has violated that, you have to report. Earlier you were reporting in yes or no. Now there's a drop-down menu stating that, for an example, if you say that there is a violation, it has been repaid a loan or you have repaid a loan in contravention of the requirement of section 269 SS and T, then you have to report it. You contravention. As soon as you say yes, there would be a drop down which says what is the nature, and then the amount has been squared up. So, for an example, there would be a loan account, and I would have a certain data account also, and I would have adjusted those amounts. Whether I need to report, yes, you will have to. And then you have to select it. So, just not report yes or no. Just do not give a disclaimer. You will have to certify and state what is the manner of that acceptance. For an example, or if I have accepted a loan in cash, you have to say it's a cash receipt. Earlier, you used to just say yes, there is a violation. Now, if you say yes, you say what is the nature, manner of that violation. Just take an example. I have a loan account. I have to repay that by an account pay check, but that loan is converted into an equity. Books of accounts, loan is getting squared up. It's getting zero. It's no more loan, so it amounts to a repayment in a loan, but it gets credited to equity. There's no payments happening. So the question will arise whether there is a violation of 269 SSST. If you read the section properly, yes, it seems a violation. You would say yes, it is not repaid by way of account, paid by a journal entry. But if the journal entry is a much wider term, if you can specifically identify that it is because of conversion into an equity, you may report it. So you may also. So that loan has been converted. That's a liability. which has been converted into an equity, yes, you may report under that. So you will have to apply your professional acumen into that on that particular things and determine that under what clause I have to report it. I have to select this. It's a very important responsibility which is on now. I'll just take an example. Again, I have a loan account. I have taken a loan also. I have accepted a loan which I need to repay today as in my SSC. And this, but at one place there is also a business transaction where I have to recover certain amounts. So can I adjust this amounts technically? If I actually so I have a recovery account, I have a loan payable in my books, I have a debtor account of that particular person, and he says that you please do adjust. He writes a letter to you, I'm not exchanging any monies, or he is into difficulties, he's gone to bankruptcy, he cannot make your payment, he cannot say that you repay me loan, I will pay you back, you can't take that particular risk. You may adjust it. There are certain circumstances wherein that adjustments do happen, and it has been seen. The question is what auditor has to report. Auditor may feel that this is the reasonable ground, that should not be a penalty imposed. No. As an auditor, yes, 271D, where is the penalty for violation of SS and ST, 271D and E respectively. There may be a reasonable ground whereby penalty may not be imposed. But obviously, whether the penalty will be imposed or may not be imposed, there was a reasonable ground. I believe that auditor may not go into that. Auditor will have to look into it, only report the factual information stating that yes, this particular loan payable has been squared up by a manner which is not through an account pay check, by a manner reported under serial number 1 to 12, that is journal entry, wherein the debtor's balance has been adjusted. And if any other item, if it does not fall within 1 to particular, then obviously any other mode, this is a residuary. You can also select that particular code and just try to report into it. As a matter of caution, as I said you, please keep it in mind, reporting under 269 SS and T itself, or this particular clause 31 itself, does not mean that there would be a penalty imposed with. There is always a reasonableness for the purpose of penalty imposed under section 271D, 271E, which is the relevant sections. And assessee can still argue. He may argue that आप इसमें report करोगे तो हमको penalty की notice आ जाएगी. It could be one of them. But as an auditor, obviously you cannot be guided by your responsibility remains to bring out the correct facts, correct reporting parameters as far as reporting under this particular clause is concerned. And when I talk of 269 SSNT, there are a lot of issues also. Sometimes I was just taking a question whether an advance receiver person for sale of goods shall also be discussed under clause. No. So you have to see the commercial transactions are not covered. It should be in the nature of loan, not a commercial transaction. Sometimes it do happens that a person receives an advance for a particular goods, but he immediately repays. Or there may be a transaction where somebody may disguise a loan as an advance and show it as a business. So obviously the auditor will have to look into a proper documentation. What has been given, you will have to look into an evidence that whether this was a business advance, whether there was a purchase order for which the advance was received actually, and it's not a loan accepted, something like that. And then look into it if it is not loan accepted, because your financial statements will also depend upon those things. You're reporting whether under a creditor or whether under an advances or whether under the loan. It all depends upon the documents which have been produced before you. So with this small things, I thought I will try to cover up because it's getting 1 o'clock on this. If I would not like to take much of this time on this, but there are very two important issues which I would like to bring out before the other members would be already joined. Chopraji is already here. Very good afternoon to the Honorable Past President Amarjit Chopra ji.
Good afternoon.
Very sir. But I've just tried to finish my session, and I know.
Please take your time.
No, sir. Tax audit will continue, but it would be very kind, and I'm happy today. Of course, Chopra sir is my mentor, I would say, and it's very nice and a great opportunity for me to hear.
Namaskar, sir.
So with this, I will. Again, Guttadaji, you may take over the session and continue with the 1 o'clock session. Thank you.
Thank you.
Thank you very much.
Yeah, CP.
Thank you very much, Piyush sir, for your deliberation on clause 20, 21, 23, and 31. I think in this ongoing session of tax audit, your points and your knowledge will ensure the members to keep reporting the same and keep the best knowledge and the best way to represent the tax audits. Thank you very much. So it is my immense pleasure, and I am fortunate enough to welcome our past president, CA Amarjit Ji Chopra, for the next session. He will be taking the session on AS1, AS4, and AS5. But let me brief introduce about our past president. He has completed his chartered accountancy in 1975 and has experience of more than 4 decades in the profession. He's the chairman, he is the president of our parent body in year 2010 to 2011. And he has also chaired the most significant committees of the institute, like accounting standard boards, auditing and assurance standard boards, corporate law committees, and expert advisory committees. And he has also delivered more than 3,000 lectures, which has benefited the members at large on professional interest in India and abroad. So it is my immense pleasure to hand over the dice to our past president, Amarjit Ji Chopra, to deliberate his words on AS 1, 5, and 4.
Thank you, CP. Just before a minute, sir, I would like to take this privilege to welcome Chopra, sir, to whom I believe he is the synonymous of audit quality. He is the thesaurus of audit standards and accounting standards, and he is the person on whom we can rely on that wherever the quality is concerned on the auditing, where is the problem of the profession is there, the person to whom the entire profession relies is the Amarjit Chopra. And sir, I'm really fan of you, and we really want that you address all of the audience today, that they can be benefited not only with the 145 accounting standard, but the basic theme of the quality of audit and quality of accounts, which we need a lot, sir, in the times to come. So thank you very much, sir, and welcome again, sir, in this webinar. It's a very short platform for a stage person like you for the answer, but it's really grateful. We are grateful that you just accepted our request and you are here, sir. Over to Amarjit Chopra, sir. Thank you very much, sir. Thanks a lot, sir.
Steve, I think a very, very senior member of the profession and one person whom I actually love and revere. I can tell you that from the core of my heart. And Piyush is there. He is like a son, if you really ask me. Because Chhajar sir was the first vice president when I entered the council. In the very first year of my entering the council, Chhajar sir was elected, his father was elected as the vice president. And the kind of equation that I've enjoyed with S.P. Chhajar sir, I think it has been phenomenal. I consider him to be my mentor so far as the council is concerned. I learned from him the financial discipline so far as the institute is concerned. I think there have been certain persons like Chhajar sir and Sita Ramanji from whom we learned a lot in terms of the financial discipline. How to do the cost cutting within the institute. Of course, there can be differences of opinion with regard to certain matters with the present generation, but I think financial discipline is very important in any walk of life. Even at your home, it is very, very important. Of course, Madhuji is there, and of course, all the participants who are there. I will only like to say, Steve, that so far as the audit quality is concerned, it is a must under all circumstances. This institute was formed in 1949 for accounting and auditing jobs. Let's be very clear about it. The objective was the accounting and auditing. Primarily, the objective was auditing, if you ask me. Because we were considered to be the watchdogs of the shareholders, the various stakeholders, over the corporates or over the people who are presenting the accounts. But unfortunately, over the years, this is one area where the credibility has been lost to a very large extent of the not in only in India. I think world over, if you ask me, the the profession has taken a hit so far as the credibility in auditing is concerned for various reasons. And I think none of the government has actually looked at the conflict of interest part, that the person who is, or rather the independence part of the auditor, the person who appoints me, you see, so far as a lawyer is concerned, it's a very different concept. You are appointed to defend that particular person. So he will defend you rightly or wrongly. So far as auditor is concerned, you are appointed to bring out the matters which require to be disclosed to the various other stakeholders. This is one basic difference. There can be mistakes, there can be errors, but this should be unintentional. This should not be intentional. To me, what is more important in life is, even if you have audited an account 4 times or 5 times, if the 6th person comes in, probably he will be able to find some kind of an error. There is no doubt about it. But that error should not be that this error was left out intentionally by somebody. Unintentional things can always happen. And of course, if the firms are growing, there are inherent risks today. One of the partners or two of the partners can commit mistakes and the entire firm can be taken to the task. This is one risk which any bigger firm actually enjoys today. If you look at the Big Four, the number of cases against the Big Four, if you ask me, I think one or the other partner keeps on committing some kind of an error or a mistake or professional misconduct. So similar things will happen when the mergers and amalgamations take place between the various firms. So one has to be very, very cautioned. One has to be very cautious when you pick up a partner. And I think one is learning by experience that this is one area that when you enter into a merger or amalgamation with any of the other firms, you should be extremely cautious in doing the due diligence about that particular firm. And if you don't do it, probably there is a great reputational risk so far as that part is concerned. Our duty is not to find out true and correct. Whatever has been talking, whatever.
Sorry to interrupt, but can you please come closer because you are not audible properly.
Okay.
To your device. Sorry to interrupt, sir. Sorry.
No issue. Whatever Piyush has been talking, 3CD, there it is true and correct. Whatever I am going to talk, it is true and fair. Let's be very clear about it. I think when I talk of 3CD to be audited, so far as 3CA is concerned, it's a different matter. 3CB is a different matter. But when it comes to 3CD, you always talk of true and correct. And I think 3CD is more a matter of certificate than anything else. There you are not talking of the true and fair. So that's the basic difference between the two concepts. If you ask me, we talk of the tax audit. But tax audit, so far as 3CD is concerned, it is more of a certificate than a audit. But in 3CB, you have to conduct the audit of the financial statements also if you are doing the audit of a non-corporate for that particular matter. So far as these 3 standards are concerned, these 3 standards are basic standards. I always say, Stevie, one thing. AS1 is the mother standard along with the AS9. If AS1 and AS9 are correct, I think most of the problems are taken care of, if you really ask me. Now, so far as AS1 is concerned, I have always said that AS1 and AS16 appear to be the easiest of the standards. But maximum deficiencies which are found out in any financial statements are with regard to AS1 and AS16 only. Piyush is sitting here. I will like to find out in how many non-corporate entities when we do the tax audit, we really take care of the AS16, particularly with regard to the borrowing cost. What borrowing costs are to be capitalized or not to be capitalized? What are the qualifying assets or not qualifying assets? So what one is trying to say is that it is not the size of the standard which should matter. It is the intent of the standard which should be very, very carefully understood by the various members. who are going to conduct the audits, who are preparing the accounts and presenting the financial statements before the auditors or before the audit committees or before the board. So far as JS1 is concerned, it talks of the disclosure of the accounting policies. Accounting policies are nothing but these are the basic principles which have been followed by a particular organization with regard to measurement and recognition of a particular item or a particular transaction. Now, there are various matters which may form part of the accounting policies. Now, depreciation is one policy. Which is the method you have followed for the purpose of the depreciation? Whether you have followed the straight line method, you have followed the written down value method. Similarly, when it comes to the inventory, what kind of valuation policies you have followed for the valuation? Similarly, for the borrowing cost, whether the borrowing cost in respect of the qualifying assets have been capitalized or not capitalized, this is again a policy which needs to be disclosed and needs to be followed also with all intent. Every accounting policy forms a part of the financial statements. Let's be very clear about it. It is 100% a part of the financial statements. It cannot be segregated or it cannot be separated from the financial statement. One of the things which has been said in the in the accounting standard 1 today is all accounting policies need to be disclosed at one place. It is not possible because earlier what used to happen was that one accounting policy you will disclose in the notes and one accounting policy you will disclose underneath a particular schedule. No, it has been prohibited so far as the accounting standard is concerned. Accounting standard says that whatever are the accounting policies, whatever may be the number of the accounting policy, whether it is with regard to amortization of the goodwill or it is with regard to the valuation of the inventories or it is with regard to impairment of the assets or it is with regard to the exchange fluctuations, you must disclose all the accounting policies at one particular place. The reason being that under no circumstances the reader of the financial statements has to actually screen the financial statements to find out where the accounting policy has been disclosed. Because sometimes what used to happen was that it was disguised underneath a particular schedule which may not be read by someone. No, you can't do that. There is no way that it can be done that way today. The other thing which this particular standard says is that there are three basic concepts of accounting which cannot be forgotten under any circumstances. And if the accounts have not been prepared according to that, those accounts need to be qualified on that particular grounds. Number one, it talks of that accrual concept is a basic concept. All accounts need to be prepared on the accrual concept basis. It is not possible that you choose a hybrid method of accounting. If a particular item has not been accounted for on an accrual basis and if that item is material, because one of the conventions, one of the assumptions in accounting is that only those transactions are important which are material basically, and the accounting policies have to be chosen in respect of the items which are actually material. I will give one example. When I say of materiality, because I talk of the assumptions, basic assumption is that all those transactions or all those accounting policies which are affecting my material items need to be disclosed. There used to be times, Madhuji, when the banks used to disclose that the certain incomes like locker rent has been accounted for on cash basis. Very frankly, if you ask me, locker rent does not form even a minuscule percentage of the total income of a particular bank. Unless your major income is from the, or your material income is from the locker rent, there is no need to disclose that particular policy that it is on cash basis, but because it is not going to affect true and fair view, It is not going to distort the opinion of the reader of the financial statement so far as your accounts are concerned. So I think you can even be silent on that particular part. So you have to disclose only those accounting policies which are material. But if the basic concept, as I said, is an accrual concept, if an accrual concept has not been followed in respect of a material item, then accounts may need to be qualified. With a proper disclosure as to what are those items which are going to affect and what is going to be the impact thereof. Basically, if either the revenue has not been booked, which is material enough, or it has been left on a cash basis, or if it is an expense which has been is being booked on a cash basis, but which is material enough and it has not been accrued. The second assumption is with regard to the going concern. Second basic concept is with regard to the going concern. When I talk of the going concern, what does it mean? It says that all the accounts are prepared on an assumption that this particular organization will continue in the periods to come and in the near future. That is a very important word. In the near future, these operations are not going to be shut down or are not going to be curtailed materially or significantly in the periods to come. If the accounts are being prepared on a going concern basis, historical cost is a matter which you can follow, basically. It's a concept which you can follow. It's a method of accounting which you can follow. But if the organization or the entity which is being audited or the accounts which are being prepared is not a going concern, then naturally the accounts have to be prepared on the realizable basis. That what you are going to realize out of this. Suppose an organization is going to be closed down in the next 6 months or next 3 months, then where is the purpose of accounting for those all fixed assets at the cost? I think the more important thing is that these should be valued at the realizable value and the reader should know as to what is going to happen to whatever investment that he has made in this particular organization. And the third basic thing which is very important that is consistency. Whatever policy you follow, whatever policy you choose, that policy has to be consistently followed. You cannot choose the policy and you cannot change a policy at your whims and fancies under also any circumstances. All those policies have to be followed consistently once you choose it. But at the same time, one thing needs to be, one has to be very careful about one thing. And I think the historical case in that particular matter is the British Paints case, which was decided by Supreme Court somewhere around 1988 or 89, somewhere or the other. What this judgment brings out is that it is not that you you choose the wrong accounting policy, you disclose that wrong accounting policy, you continue to follow that wrong accounting policy, and you say that I have followed this policy for innumerable number of years, so this becomes a valid accounting policy. If you have followed a wrong accounting policy, it remains a wrong accounting policy. Even if it has been followed for a number of years, and if it has been disclosed for any number of years. In British Paints case, what happened was that the company was valuing the work in progress at the direct cost. And income tax assessments were being made by the income tax authorities for a number of years based upon the disclosure, based upon the whatever policy was being followed by the company for any number of years. But one day, one of the assessing officers said that I do not agree with you of this valuation, and he rejected their books of accounts. He said that valuing work in progress at direct cost does not give a true and fair view of the valuation of the inventories. And he rejected the books of accounts and made some additions. British Paints case was that we have been valuing these inventories on work in progress at the direct cost for any number of years, have been disclosing this accounting policy. It has been accepted by the department all these years. The case went on and on for any number of years. I think it went on for more than 20 years. And then ultimately the Supreme Court said in this particular case that if you pick up a wrong accounting policy and you continue to follow that wrong accounting policy for any number of years, it does not get validated on that particular ground. There's no way that it can stand validated. And they upheld the contention of the assessing officer who had rejected the books of accounts. So one needs to be very clear, one needs to be absolutely sure about it, that whatever accounting policy you choose, whether in respect of the property, plant and equipment, or in respect of the inventories, or in respect of the impairment of the assets, etc., or with regard to the contingent liabilities, this should be a correct accounting policy. If it is not a correct accounting policy, even if you keep disclosing that for any number of years, it will not get validated under those circumstances. And it is subject to challenge by anyone, and it can lead to misconduct on the part of the auditors also if they fail to report that particular departure. And three basic assumptions which go into choosing of any accounting policy for that matter is: number one, that all material items, there has to be an accounting policy with regard to all material items so far as that particular part is concerned. You cannot have an accounting policy with regard to immaterial items, and even if you have it, it does not make any difference so far as the disclosure part is concerned. So I think that's an important angle to the entire thing, is that you need to be very clear as to what you are doing so far as this particular part is concerned. And the other thing that you need to be very clear is that all those policies need to be disclosed, and then prudence is the hallmark of any accounting policy. Prudence would mean, though under Ind AS, it may not apply 100%, very frankly, because today we are all talking of the fair values. But when you talk of inventory valuation, what do you say? Lower of the cost or net realizable value? If your net realizable value is low, you are going to value those inventories at the net realizable value. Or if your cost is lower, in that case, the inventory will be valued at the cost in that particular circumstances. Because this policy says that under no circumstances, this particular consideration of choosing an accounting policy says very clearly that you cannot choose an accounting policy which takes into consideration the future gains. It may account for future losses. It should account for the future losses, but it should not, under any circumstances, book the future gains on this particular date. And besides materiality and prudence, the third basic thing which comes into selection of an accounting policy is the substance over the form. Form is not important. What is important is the substance today, very frankly. When I talk of substances, if you look at it, in Schedule 3, there used to be various items earlier, and then suddenly we came up with an accounting standard called AS 22. There was no item like deferred tax in the Schedule 3. But then deferred tax had to be disclosed. But where it has to be disclosed? It has to be disclosed between the current liabilities and, of course, the borrowing somewhere. So what was important is that whatever you do, it is the substance which is very important. Substance of the transaction is very important. You take the case of the leases for that matter. Now you have a finance lease. In the case of the finance lease, who is the real owner? The asset may be with someone else. That's a different matter for that matter. It is not the name of the person which is important. It is the transaction which is very important. Ultimately, this asset is going to belong to whom? I think that is the important part today. So what is important is that the substance of the transaction is far more important. So, and the accounting policy has to reflect the substance of the transaction. The accounting policy doesn't have to reflect the form of the transaction. If the form of the transaction is to be only picked up as an accounting policy, it will be a misreporting of the various items so far as that part is concerned. As I said to begin with, There are various areas in respect of which the accounting policies can be chosen. These are the methods of depreciation. This is expenditure during the construction period, which can be taken that way, or it's the conversion of the translation of the foreign currency items, or this is the valuation of inventories, this is the valuation of the investments, etc., etc. As I said to begin with, one very important factor that I made out was consistency is the hallmark of an accounting policy. One thing you have to be very, very clear about. When you change an accounting policy, when you wish to change an accounting policy, can the accounting policy be changed according to the whims and fancies of the preparers of the financial statements, or this can be only chosen, or it can be changed based upon certain other conditions? Those conditions have been provided in the accounting standard 5. There I will go to a bit later. What I am trying to say is, no preparer of the financial statement has got an unfettered right to change the accounting policy because they want to choose a particular accounting policy. There have been cases, very frankly, if you ask me, where people change the accounting policy from WDV to straight line method of depreciation whenever a public issue was to be brought in, because the straight line would result into a low rate of depreciation in certain circumstances. And they would resort to WDV depreciation whenever the deferred tax asset would come into play, whenever the MAT would come into play. That cannot be the basis. Basis of change in accounting policy is not what the preparer of the financial statements chooses to disclose. Selection of an accounting policy is important with regard to presentation of the true and fair view, and that is why 3 conditions have been laid down for any change of accounting policies in the accounting standard 5 for that particular matter. I'm not discussing that right now because I will have to discuss that in the AS5 at that particular point of time. But what I'm trying to tell you people is that this standard AS1 is very simple looking, but some of the auditors, what do? They are over enthusiastic in certain cases. This standard very clearly says that the management can choose a change in accounting policy, can adopt for a change in accounting policy under the circumstances provided in AS5, and they have to disclose the fact and effect of the change in the accounting policy. Now, if the fact and effect both have been disclosed by the management, the auditor doesn't have to bring anything on record so far as the report is concerned. Sometimes what happens is, the auditor starts believing that if there is a change in the accounting policy, somewhere it is in his domain, even if the fact and effect has been disclosed, that he has to bring a disclosure with regard thereto in his report. To my mind, my answer is no. I am subject to correction by anyone, by any other expert. But I am very clear in my view, the entire accounting standard 1 is based upon one reasoning. That is the disclosure. That the reader must come to know that an accounting policy has undergone a change. Why it has undergone a change, that fact should be disclosed. And what is the effect of that particular accounting policy change, that should also be disclosed. One very important part which AS1 brings on record is that it is not important that the accounting policy change may affect your accounts only this year. It is also possible that the change in accounting policy may affect your accounts subsequently in a much larger way in the next year. And if that is going to happen, probably that has to be kept under consideration, and the fact thereof has to be brought on record. I will give one example again. The example is clear. If your inventories are very, very low, minimal, and you change your method of valuation, this year it may not affect it. This year, suppose the inventories are hardly 5%. Normally, your inventories are to the extent of about 50%. Or say, normal your stocks are to the extent of about 3 months of your turnover. But this year, and generally that level of inventory should be there. But this year, your level of inventory is only to the extent of about 5% of the total turnover for various reasons, whether the seasonal sale took place or any other thing happened. That GST reduction took place and people became very enthusiastic and purchased everything from you. But next year again the level is going to be the same because that enthusiasm is already gone. People have come, purchased it, and now the next year again the normal sales will take place. If you ask me this year, after 22nd September, before 22nd September, if you consider that, and if you consider post 22nd September, the total volume of the sale in the, you can say, the white goods there has been a vast difference for various reasons. Suppose this was near to 31st of March. Then what happens? That the inventories near 31st of March could be much lower. But in the subsequent period, once people have become accustomed to that particular price, again your level of the inventories would be about 3 months. If that is going to happen, then what happens? I think that's an important angle that we must consider, and that fact has to be disclosed. That this year the impact may be minimal, but next year this impact is going to be much larger because the level of inventory is going to be larger. So all those things have to be considered. AS1 brings out all these facts very, very clearly. You may have to read in between the lines. Accounts cannot be taken on their face value. And again, I repeat, accounting policies cannot be merged in the schedules under any circumstances. All accounting policies have to be disclosed at one place. Or the disclosure of accounting policies has to be clear, it has to be concise under all circumstances. The points which need to be remembered is that whatever accounting policy you choose, it has to be based upon the fundamental principles of accounting, of going concern, and of course, consistency has to be followed under all circumstances. And of course, this has to be based upon the accrual concept, and those aspects have to be disclosed. And if those have not been followed, all that disclosure and the effect thereof has to be brought on record. So this is all with regard to AS1. Madhuji, is there any provision with regard to any of the questions to be asked? If no, then I will continue. Then comes the question of the accounting standard 4. So far as AS4 is concerned, earlier it used to deal with the contingencies and events occurring after the date of the balance sheet. But today, if you ask me, contingencies or contingent liabilities have all gone into the accounting standard 29. This standard is more or less now left only to deal with the events subsequent to the date of the balance sheet. This is one standard along with AS5, which are very commonly misunderstood to a very, very large extent. Madhuji, since you are appearing now on the screen, may I ask you one simple question? Or is there any provision for the questions to be asked?
Yes, sir.
Will any questions be asked? Is there any provision for any questions, or this is only a recording, nothing else?
No, sir, there is a question and answer session.
Sir, the questions are available. However, so they have been parked for the session to end.
You
then
can ask the
they can-
questions with regard to AS1 right now. I can answer those and then proceed.
Sure.
If you can answer those, if you can ask me those questions, I will answer those questions and then proceed with the AS4 and AS5.
So if the participants have any question regarding AS1, kindly ask now. So I can answer that, and then we will move to AS4 and 5.
नहीं है मधुरी कोई क्वेश्चन नहीं है
No, sir.
No. Then I proceed. So far as AS4 is concerned, I have already said that earlier this used to deal with the contingencies and events occurring after the date of the balance sheet. But today this deals primarily with events occurring after the date of the balance sheet, because all the contingent liabilities have gone under the AS29 for that matter. But I will like to define contingencies here some or the other. A contingency as per the standard is a condition or situation, the ultimate outcome of which, gain or loss, it can be a gain or loss, will be known or determined only on the occurrence or non-occurrence of one or more uncertain future events. What it tries to say is that suppose you have filed a suit in the court of law to recover a particular amount, and that you are not aware as to what is going to happen, whether you will be able to recover the full amount, you will be able to recover 25%, you may be able to recover only 10 paisa, or you may not be able to recover any amount, or you may be able to recover the full amount. The outcome can be either in your favor or it can be against you. But it is not in your hand. It is in hands of someone else. So it is an uncertain event which is bound to occur, which is likely to occur at a future date, because it affects my entire financial statement, particularly with regard to events occurring after the date of the balance sheet. That's why I think that is why these contingencies were included under this. But contingent liabilities now have been actually excluded from here and taken to S29. And so far as the event occurring after the date of the balance sheet is concerned, these have been defined in this very standard as are those significant events, both favorable and unfavorable, that occur between the balance sheet date and the date on which the financial statements are approved by the competent authority, which can be board of directors, it can be partners, it can be the proprietor, whosoever it is, board of directors in the case of the company, and by the corresponding approving authority in the case of any other entity. क्योंकि कंपनी के केस में तो this is always done by the board of directors. First it goes to the audit committee recommends it to the board, and board then approves it. In the private limited companies, there may not even be the audit committees for that matter, and it goes directly to the board. Two types of events can be there. One event is those provide evidence, further evidence of the conditions that existed on the date of the balance sheet, and those which are indicative of the conditions that arose subsequent to the balance sheet date. दो तरीके की कंडीशन हो सकती है। एक तो ये बताएं कि बैलेंस शीट की डेट पे क्या कंडीशंस एग्जिस्ट करती थी, और कुछ ऐसी हो सकती है जो ये इंडिकेट करे जो बैलेंस शीट के डेट के बाद क्या हुआ। ये बड़ा एक इंपॉर्टेंट सवाल है, वेरी फ्रेंकली दिस इज अ वेरी इंपॉर्टेंट पार्ट देयर ऑफ, and this is not only applicable to companies, let's be very clear, this standard is applicable to every non-corporate entity, and this we need to take care of. If we are tax auditing any non-corporate entity, this standard has to be followed in the true spirit thereof. It says that there, as I talked of to begin with, that you have filed a case against somebody, and you don't know as on 31st March, if 31st March comes in between, you do not know as to what is going to happen in that particular case. Now, if nothing happens till the time the accounts are approved and signed by the auditors, you don't have to be worried about it. But before the date of the approval of the account, if this happens, that the court decides the case against you and says you have to only recover 25% or 30% or 40%, then necessarily, mandatorily, let's be clear about it, you will have to write off the balance amount. You will have to make the adjustment in the books of the account. Why? Because that condition existed on the date of the balance sheet. There can be two kind of situations occurring, arising post the date of the balance sheet, before the approval of the accounts of the account. One is that the conditions never existed on the date of the balance sheet. Those conditions didn't exist on the date of the balance sheet. No suit had been filed. But the party writes a letter to me later on, no, sir, I'm not going to do it. It's a different matter altogether. The dispute arises later on. One is that the dispute was already there on the date of the balance sheet. You knew about it. You were only waiting for the outcome, and the outcome has come. If the outcome has come, then it becomes an adjusting event. But if certain event occurs for which there were no conditions existing on the date of the balance sheet, then you need not adjust it. Then you need not adjust it. This is one of the very, very important angles which you need to take care of. Because there can be a situation that a fire occurs in the factory post 31st March and certain materials are damaged, fixed assets are damaged. In that case, it's not an adjusting event. You will not make adjustments in the balance sheet on that particular account. But you will disclose, you will ensure that the board of directors or the partners or the proprietor has disclosed it adequately so that the reader of the financial statement knows what happened in between the date of the balance sheet and up to the date on which the accounts were approved. You need not come into play otherwise. But if they have not disclosed it, then there is a requirement that you should take into you should come into play. But if they have disclosed it, there is no role for you as an auditor. The only requirement of the standard is that if an event occurs in respect of a condition which never existed on the date of the balance sheet, and it has affected some of the assets or liabilities. In that particular case, you need not adjust it on the date of the balance sheet. But if the condition existed on the date of the balance sheet, suppose there is a creditor who has already filed a case against you. There is a banker who has filed a case against you. When the banker succeeds, that you have to pay even the penal rate of interest. On 31st of March, this case was existing. This case was there. And now the court has decided before the accounts were to be approved, yes, you have to pay the penal interest. In that case, you will have to account for this penal interest on 31st March itself. But if the bank charged penal interest subsequently, and even if you agree to pay the penal interest subsequently, the dispute arose subsequent to the date of the balance sheet. That is, post 31st of March, there is a dispute. In that case, this fact has to be reported by the board of directors or by the partners or by the proprietor, wherever they have to report it. In the case of the companies, the board of directors have to report in their report. And in the case of the partners, this can be disclosed by them. But you don't have to make adjustment to the balance sheet in that particular case. Contingent gains are not to be adjusted. Contingent losses are to be adjusted in any case. That even the AS29 says that particular way. What is important for you to know is that what are the kind of events which lead to adjustments on the date of the balance sheet, and what are the events which don't require adjustments to the assets or liabilities on the date of the balance sheet. If there is a situation, there is a condition which is existing on the date of the balance sheet, which is evidenced subsequently by the events, outcome of the events, subsequent events, either in your favor or against, please account for that. If there are conditions which arose only subsequent to the date of the balance sheet, don't go in for that. You take the case of the purchase returns, you take the case of the sales returns. Suppose you had accepted certain goods as on 31st March, you have already accounted for those as inventory, you have accounted for that as purchases. But as these goods go to the shop floor finds that there have been certain deficiencies in the quality, and you decide to return those goods. Don't account for those, but that is in the month of May or in the month of June or in the month of April, and don't make adjustments for those purchase returns as on 31st of March. You will have to make adjustments only for those things which existed. If on 31st March itself, you had written to them that there are deficiencies and we are going to return the goods, or we are going to make you certain debits with regard to the deficiency in the quality, and now subsequently they have agreed, okay, debit of some account, please adjust that as on 31st March. But if these deficiencies were noticed only subsequent to the date of the balance sheet, when you wrote to them, you only subsequently, you don't make adjustment on the date of the balance sheet. The only thing is that if the substratum of a business is lost, suppose subsequent to the date of the balance sheet, there is a fire, there is a flood, there is anything else, dispute among the partners, that the business is going to be closed down, then it is no more a going concern. Let's be clear about it. In that case, whatever adjustment you have to make on 31st March, please make those adjustments. Otherwise, this standard will not come in. This standard will come into play in any case, but the adjustments to the assets or liability will not have to be made. This is all with regard to AS4, nothing else. It says you make it a point to say very clearly what adjustment you have made, what adjustment you have not made. You will make adjustment. You can say that we have complied with AS4 by making the adjustments which are required to be made because those conditions existed on the date of the balance sheet and which have been further evidenced by the events subsequent to the date of the balance sheet. And so far as the other part is concerned, you need to disclose that the board will need to disclose those areas, that there are certain losses or gains which are likely to arise in future because of certain events which have happened post the date of the balance sheet, but before the accounts are approved by the. अगर accounts के बाद होता तो फिर आपको भी कुछ नहीं करना ना मैनेजमेंट को कुछ करना, फिर वो अगले साल देखेंगे whatever has to be done. So far as AS5 is concerned, again AS5 is one of the most misunderstood standards. Very simple, but one of the most misunderstood standards. Vishnuji, namaskar. And Pramod,
namaste, sir. Namaste, sir.
Namaskar, Pramod and Vishnuji. The two sitting joints in the council member, in the council. My salute to them for the work that they are carrying out. That's all I can say. So far as AS5 is concerned, अगर मेरा टाइम अप हो गया तो बता दीजिएगा प्रमोद जी, because I think I'm
नहीं सर, पूरा टाइम सर, पूरा टाइम है सर.
No, I think I'm running out of my time now.
No. We have got full time, sir.
You take your own time, sir.
Full time.
So I think in 10 minutes I will wind up. No, not more than that. So maybe 5 minutes I overdo.
Sure.
So far as AS5 is concerned, it is again one of the most misunderstood standards. The entire purpose of AS5 is to give an idea to the reader of the financial statements as to what is the impact of any item in the P&L account or in the balance sheet which has impacted me because of my errors in the past or because of certain exceptional things which have happened during the year or because of certain extraordinary items which have occurred during the year. The reader of the financial statement should be able to make out the exact impact of certain transactions, of certain items which appear in the profit and loss account or somewhere else, which have arisen because of the earlier year problems. Now, when I say prior period item does not mean that if I have paid something with regard to the earlier year, it is necessarily a prior period item. No, not that way. There can be a case where there were certain disputes going on with the trade unions, and trade unions were demanding higher wages. We were not agreeing to that, and that is why those wages were not accounted for in the earlier years. This year we agree. वो 100 रुपया डिमांड कर रहे थे, हमने 50 रुपए पे एग्री कर दिया, 50 रुपए उनको दे दिए. This 50 rupees is the expenditure which has been incurred maybe in respect of the earlier years, but it is not an expenditure which can be termed as a prior period item. That is the basic difference. Prior period item is one, a debit or credit. It can be income or expense, either of the two things, which arises on account of some error or omission which took place at the time of the preparation of the financial statements in the earlier year. Example, rent was to be accounted for a period of 12 months in the last year, but unfortunately by omission I accounted for only for 11 months. Whatever I didn't accrue for the 12th month, And if I account for during the current year, and if this is material enough, then it is a prior period item. The bank was supposed to charge me 12%, but by mistake they kept on charging me 10%. And I also knew that they were supposed to charge, because I've got the agreement with me on the borrowings, that I'm supposed to pay 12%. But I was very happy that they are charging me 10%. I kept on accounting for only 10%. So that 2% which they charge me this year now was an error or omission committed by me at the time of preparation of the financial statements in any of the earlier years. This becomes a prior period item. Similarly, there were fixed deposits which are made with the banks. Now, those fixed deposits with the banks are there. I did not accrue the interest in the earlier year, because my AS line very clearly says that so far as interest is concerned, it has to be booked on the time period. It is not when you receive it. And that is what my AS1 said, that you have to follow the accrual concept of accounting. No, whatever interest was to be accrued, I didn't accrue the interest. And also I did not show the fixed deposit at a higher amount, or I didn't show on the asset side the interest accrued but not received. So one error in the profit and loss account and one error in the balance sheet. That income was shown lesser, and on the asset side, the asset was shown lesser. Now, in the P&L account, this will be treated as a prior period item. My accounting standard says either I say on the face of the profit and loss account that it is a prior period item. What is my profit for the current period? And then subtract it. What is the prior period item? And then say that this is the profit, net profit otherwise. The reader of the financial statement must be very clear that what is my profit for the current year and what is my profit after charging or after accounting for the income of the earlier years. Because there can be circumstances where the situation or the accounting standard itself says you may not show it on the face of the profit and loss account, where you have booked in the normal cases, you have booked the rent. In the normal case, you have booked the interest. In the schedule, you say that this much includes in respect of the prior periods. But to me, if you ask me, the transparency would require that I show it on the face of the profit and loss account better. The reader may not have to track it. What is the prior period item in the schedule itself or in the notes itself? For the sake, of course, the accounting standard permits it, so you can do it. There's no doubt about it. But if a good accounting practice is to be followed, to my mind, it should be shown on the face of the profit and loss account itself as to what is in respect of the prior period and what is in respect of the current period, and what has been the impact of the current of the item on the current year profits, so far as this particular part is concerned. This standard also deals with something called exceptional item and something called extraordinary item. Some of us misunderstand that if there is a large amount, suppose in advertisement this year I incur normal expenditure was say 10 lakh rupees every year. This year I have incurred an expenditure of 60 lakhs. Also, it is an extraordinary item. No, it is not an extraordinary item. It is in the normal course of the business. It can be an exceptional item. It can be an exceptional item under certain circumstances. I will deal with that. Suppose, as I talked to you earlier, there has been a dispute with regard to the trade unions. Trade unions have been demanding higher wages. And I agree with them that, okay, in the current year, I agree with them that I will pay you higher wages. But instead of your 100, I will pay you 50. In respect of the earlier years, whatever has been the increase, I will pay you 50. In respect of the current year, I'll pay you whatever you demand. No, whatever is the additional amount paid during the current year, inclusive of the earlier years, this can be an exceptional item, but it is not a prior period item. Because the dispute has been settled this year, there was no error or omission committed at the time of the preparation of the accounts in the earlier years. This item has arisen on account, I have personally agreed to it. So at the time of preparation of the financial statements earlier years, there was no agreement with the parties. The dispute was going on. At the best, it could have been considered as a contingent liability. Nothing more than that. But having agreed to it this time, the reader of the financial statement has a right to know how much it has impacted its current year profits, whereas it could have impacted the last year profits. Why my profit has gone down this year compared to earlier years? Because he's trying to make a comparison. Or similar case can be with regard to the income also. That there was a dispute with one of the buyers to whom I had sold the goods. I had been demanding certain interest from him for the delayed payments, which he was not making. And this year he has agreed to pay me even in respect of the earlier years. This is at the best an exceptional item, and I should disclose it as an exceptional item. But this remains a profit for the current year, no doubt about it. But I am showing it as an exceptional item because the reader of the financial statement should know that this is not exactly a profit for the current year. This is a profit in respect of the earlier years also. And next year again, the profit will be lower because this exceptional item will not be there in the subsequent periods. The entire idea of having the exceptional item disclosure is, or prior period item disclosure is, that the reader of the financial statement should be able to appreciate the current year's profits compared to the earlier year's profits and the subsequent year's profits. I think that is a very important factor that we need to consider. Why this standard is there? This standard is there to enable the reader of the financial statement to appreciate the fact that what is the impact of the either prior period items or of the exceptional items on my current year's profitability, either on the income side or on the expense side for that matter. So far as extraordinary items are concerned, very frankly, if you ask me, there is hardly any extraordinary item, because extraordinary item is something which does not arise in the normal, in the ordinary course of the business, either an expense or an income, or a loss or a gain. No extraordinary item can be considered that there is a flood or there is a fire or there is a theft. Now this has nothing to do with my business, because as a consequence of these things, if I suffer certain losses, or as a consequence of this, if I gain something because of the extra claims or because of the extra government grant, कि भाई यहाँ पे कोई natural calamity हुई है, and because of that I am able to gain something, then it is extraordinary, because it is not arising in the ordinary course of the business. Then I must disclose it as an extraordinary business, extraordinary item. Again, the purpose is the same, that the reader of the financial statement should know that this was something which was beyond my control. And again, next year it is not going to happen. It is, and why it is different from the last year? Because of this particular extraordinary item. So this accounting standard deals with basically the prior period item, exceptional item, and of course the extraordinary item. But the most important aspect of AS5 is, which I talked of in AS1, change in the accounting policy. When can you change an accounting policy? Can you change an accounting policy at the drop of the hat or at your whims and fancies? The answer is no. This standard very clearly says you can change an accounting policy under any of the three circumstances. Number one, if there is a change in law. The government changes the law. And because of the change in law, you have to change the accounting policy. Suppose you have been accounting for certain depreciation at a particular in a particular method, and the government says, no, you cannot do it. You will have to account for only in this particular method. As it happened in 99, inventory valuation earlier could have been done by even LIFO method. But then the accounting standard came and became mandatory. And then it became a part of the Companies Act also, and it said very, very clearly that you cannot have LIFO method valuation. Now, if you change the accounting policy from FIFO to LIFO, the valuation policy, in that case, this is something which has to do with something with the change in the law or with the change in the accounting standard. If there is a change in the accounting standard, now suppose today there is a particular treatment which is permitted with regard to the impairment of the intangible asset. Tomorrow it says no, there is no need to do it. And then you follow that particular method. Because that change in accounting policy is because of the change in the accounting standard itself. It can be either on because of the change in law, or it can be on account of the change in the accounting standard, or most importantly, if it leads to more true and fair view presentation of the financial statements. You may be able to change an accounting policy if you feel and you can demonstrate that changing the accounting policy will result into a far better presentation of the financial statement so far as true and fair view is concerned. Very simple. If the economic life of your asset undergoes a change, you will change the depreciation or amortization of that particular asset. It may not be a change in account because it's a change in estimate for that matter. It will not be a change in accounting policy. But change in accounting policy can also take place if you feel that it will lead to a far better presentation of the financial statements. So what I'm trying to say is that AS5 is very, very important. And AS5 and AS1 with regard to change in accounting policy have to be read as one. Because AS1 allows the change of the accounting policy. AS5 lays down the conditions under which the accounting policy can be changed. I thought that these are the important areas so far as these three standards are concerned. So thank you very much, Gupta ji, Vishnu ji, Pramod ji, and of course Deepak, who has been responsible for my being here today, for that matter, and Madhu ji. Thank you very much.
Sir, thank you very much, sir, for giving
Thank you so much.
benefit of all the members, sir, and your wide experience, sir. I believe, sir, our each and every member, sir, has benefited with your valuable time, sir. Thanks from my bottom of heart, sir. And I again welcome Pramod Jain, but Central Council member, my colleague in the council, for practical aspect of the tax audit. Because tax
I can only say Vishnu ji, a diamond from our region.
So nice of you, sir. So kind of you, sir.
Thank you.
So I request our moderator to introduce our Pramod Jain ji.
So I will take your leave, sir. Thank you very much.
Thank you, sir.
Thank you,
God
sir.
bless you all.
Thank you, sir. Thank you.
Happy Karma Chauthi, everybody. That's what I
Thank
can say.
Thank you very much, sir.
Thank you, sir.
Thank you.
Thank you.
Thank you, sir.
Friends,
Bye.
for Pramod Jain ji, I can say one thing. Whenever any matter comes for the expert opinion for any topic, not only for the income tax and not only for the company law, he is always ready to give opinion on that particular matter. From last 8 months, I'm working with the Pramod Jain ji in the Central Council. He always speaks whenever it requires in the council, and he gives full time to the council. And whenever we meet in any occasion, after the council meeting, after the committee meeting, he always talk about the student and the members and how the growth of the members and our student in our country. Sir, thank you very much for giving your valuable time for our CP committee and the members for the practical aspect for the tax audit. And I believe, sir, each and every member is today's present here will be benefited with your wide experience in the income tax. Thank you, sir. I request our moderator to please introduce today's session speaker, Sri Pramod Jain ji, our Central Council member, learned Central Council member from last 3 terms. So I request moderator to please introduce.
Thank you very much, sir. It is my pleasure to introduce. It is my pleasure to introduce our next speaker and our esteemed guest, CA Pramod Jain, sir. He is elected as Central Council member of ICAI for the period 2019 to 22 and 2022 to 25, and then ongoing council also for the period 2025 to 29. He is the chairman of Expert Advisory Committee for the year 2025-26, and he was also served as the chairman of Expert Advisory Committee for the period 2022 to 23. He is a convener of Center of Audit Quality Directorate for the year 2025 to 26 and several other bodies of ICAI. He is the conceptualizer of the portal www.expertpanel.in, in which one-stop solution for all professional queries, which have been given more than 37,500 answers since its launch in mid of the year 2018. He has delivered more than 1,800 lectures and articles on various topics like income tax, corporate laws, LLPs, audits, peer review, quality review, etc. And more than 200 forums throughout the countries. Most of his presentation and articles are available for free download from www.lunavat.com and from 2018 at www.expertpanel.in also. Sir is going to enlighten today with the practical aspects of tax audits, which will going to benefit our members. And now I'm handing over the dice to Sri Pramod Jain sir for taking the next session. Handing over to you, sir.
Thank you very much, Madhuji. My very, very dear friend, CA Vishnu Agrawalji. The first time council member, I would say, joined this year. But of course, his experience is so vast that actually the members in the Western region know, because he has been chair of the largest regional council, the WIRC out there, and also, of course, in this current 1 year when we have when we have been working together. Vishnu Bhai is
सर टेक्निकल टीम प्लीज चेक भाई किसी का माइक डिस्टरबेंस आ रहा है.
Vishnu Bhai not only is the vice chair of this CP committee, which is organizing this program, but also the vice chairman of the most important committee, which is in the blood of every chartered accountant, that is the income tax, that is the direct tax committee. And he has played a very, very important role in bringing this Income Tax Bill 2025 to an Income Tax Act 2025, making representations to the Select Committee, to the CBDT time and again, and making so many representations time and again. And now, of course, Vishnu Bhai is working upon the rules, I would say, rules of the Income Tax Act 2025, which we are hoping that they would be coming, say, by this year end, that is December 2025, maybe by December 2025. And also, he is the vice chair of another very, very important directorate, that is the Financial and Tax Literacy Directorate, which is empowering or helping not only chartered accountants, but beyond chartered accountants, the homemakers, the employees, the smaller entities, businessmen, that making them aware about the smaller things into the savings, the taxation, the credits, the frauds, and all those things, through the financial tax literacy drive which have been happening over the years. Thank you, Vishnu Bhai, for always being there and sharing your views in the council also, apart from all the committee meetings which we are having there. Thank you, Vishnu. And first, of course, thank you for giving me an opportunity to share my views on this practical aspect of tax audit, because to my information, I was given that several of the clauses of 3CD have already been taken by speakers earlier. Today also, earlier also, I have been informed that certain clauses have been taken. Also, I will not be going into specific clause unless someone is issue. I don't know whether I can communicate or have through the chat any discussion with the participants. Deepak ji or tech people can inform me whether if I ask a question, would they be able to respond through the chats or somewhere or no? I'm just asking.
Just get back, sir.
Hanji?
I will just get back, sir. Asking the technical team, sir.
Please get back to me, because accordingly I'll make a presentation. I got a PPT to share, but if the participants are not able to respond back to my questions, then I'll skip those slides which contain certain questions. I'll just bring out the final point into that, but not ask the questions. So kindly inform me.
I will.
I'm waiting for a few seconds.
Sir, you start the session only. I think the audience will not be able to revert you back like that.
They
So
won't be
you
able
can
to.
just take up the session. Yeah. Yes, sir.
Okay. Got it.
Yes,
Got it.
sir.
Got it. Thank you. So I'll be sharing my screen.
So there is going to be a delay of around 30 to 45 seconds in your delivery and the response of the participants. So I guess it would be better to skip that.
Okay. Is my screen visible?
Yes, sir, it's visible.
Thank you. Thank you. Friends, everyone knows that this tax audit came into the act, and the chartered accountants were empowered to conduct the tax audit and issue their reports to the businesses and the professions with the initial very, very lower limits, and since 1984-85. So since then, the tax audit is there, which we say under Section 44AB. It is there since 1984-85. Earlier, what used to happen that most of the cases under the income tax were selected for scrutiny, but government wanted that they should engage certain professionals, whereby for their assessments, they engage certain professionals who can verify at their end the certain points which they wanted, so that the scrutiny of 100% can be reduced to the minimal which they wanted. And of course, no other professional other than the chartered accountant, they found, that who understands income tax, who understands financial statements, who understands the audit. So since then, chartered accountants who are in practice have been entrusted with this job under the Income Tax Act to conduct this tax audit and issue their report to the assessees, who have to submit it to the assessing officer. The procedures, of course, it was physically earlier, and then slowly and gradually it was digitized and uploading was done, where both assessee and the chartered accountant, they appointment procedure and then uploading and then approval, everything started happening. Now, if I talk about tax audit, the relevant provision, whenever I go into certain presentations which I make physically, the first question which I normally ask is that does anyone do a tax audit under Section 44 AD? And of course, many of the hands are up. They say that yes, we do the tax audit, but the fact is no. The fact is no. There is no audit under Section 44 AD. If you have to see that when an audit is required, the audit is required only under one provision, which is Section 44AB. If a assessee falls into any of the 5 clauses of 44AB, only in that case, the audit is required and is to be done. And if the assessee falls into any of these five cases, then when the audit is required, then he has to go for the Rule 6G to furnish the reports. And for that, the report formats are in either 3CA or 3CB. And particulars which we talk about 3CD, they are annexed to both these forms, any of these forms, 3CA or 3CB. And non-compliance of this tax audits, the penalty is there, which is under section 271B. So let us just refresh what are these five clauses. What are these five clauses under which the tax audit is required and can be done? These five clauses, if I talk about, if we say in case of business, if an assessee is having an income from business and its sales turnover or gross receipts exceeds 1 crore or 10 crore, we will be talking about what is 1 crore, what is 10 crore. When it is 1 crore, when it is 10 crore, in that case, the audit would be required under section 44ABA. In case the assessee is having a professional income and its gross receipt exceeds rupees 50 lakhs, then the audit is required under section 44ABB. And in case the assessee is covered under the presumptive taxation of section 44AE, double B or triple B, and the income is less than the deemed profit, then the audit is under section 44ABC. And in case it is a profession which is covered under section 44 ADA, and the profit which is declared, the deemed profit which is less than 50%, and the total income is exceeding the maximum amount not chargeable to tax, then the audit is under section 44 ABD. And in case the assessee is covered under 44 AD4 and the tax and that is total income is exceeding the maximum amount not chargeable to tax, then the audit is under section 44 ABE. Friends, if we see these five clauses, an audit can be conducted under in any of these for any of these five clauses only. Clause A is for business, clause B is for profession, and all these three are for presumptive. Only for presumptive. So A business, B profession, and if the profit is declared less than the presumptive incomes, this section 44A double B triple B or 44 ADA AD4, in that case the audit is required. Now in these three last presumptive income due to which the audit is required under section 44AB, again there is a difference. For example, in section 44A, which is for the goods carriage vehicle, any assessee who is having less than 10 trucks and they are not owning, they are owning those 10 trucks, less than 10 trucks, and they are not declaring the deemed income which is given under those section, then they have to not see anything else but have to get that audited irrespective of whatever their turnover is. In case of a profession and business, apart from the deeming thing, the other condition is that total income should exceed the maximum amount not chargeable to tax. Say in the case of individual HUF, it should be more than 2,50,000. In case of partnership firm LLP, it should be more than zero. Right? Not LLP, only the partnership firm, zero. Because LLPs are not covered under the presumptive incomes. They are not covered under the presumptive incomes. So for that, the two conditions are required. Now, if the assessee is covered under any of these five provisions, then the audit is required, and then they have to issue a report 3CA and 3CB. And many a times we have seen the auditor sometimes misses, and irrespective and certain times where the audit is required under form 3CA, he issues 3CB, or where it is required under 3CB, he issues 3CA. And it is not about only the companies. Even in case of a limited liability partnership or a society where an audit is required under any other law, that is a Limited Liability Partnership Act, it is required under the Limited Liability Partnership Act 2008, or a Societies Registration Act 1860. So in that case, if the tax audit is required, then the audit report for the tax audit 44AB would be under form 3CA. And why that is so? Because when we'll be going into Form 3CA, 3CB, we'll be understanding what is the requirement. Because the audit of the financial statements is required under any other law. So under tax audit, that again the financial statements are not to be audited. And Form 3CB for any other audit. Let me take a very simple case, friends. We have seen that many state PSUs, the statutory audits are not done on time. It is pending for more than 2 years, 3 years, and they have to comply with the income tax. They want the tax audit to be done. So in that case of the statutory PSUs, the state PSUs, the state companies, I would say, PSU companies, because the audit is not done under the Companies Act, when the tax auditor is issuing the tax audit report in 3CB, he has to issue the audit report in 3CB and audit the financial statements also. He has to give the true and fair view of those financial statements also, even though the statutory auditor has not done. He cannot add a provisional financial statement, friends. It is mandatory. Please see, in such cases where the audit is not done under any other law, you have to invariably issue 3CB. Another case I'll take, suppose a company's financial year, it is allowed, certain conditions, is ending as on 31st December, because they have to uh, have a consolidated financial statement with the overseas holding company. So they've taken approval from the competent authority under the company law. So their audit under the company law is for the calendar year, but under income tax, the financial is permanent from 1st April to 31st March. So even for those companies, the audit report under Section 44AB would not be in Form 3CA, but in Form 3CB. 3CD is, of course, a particulars both for 3CA as well as 3CB. These 44 clauses have to be. However, the auditors are more, their final product is 3CA, 3CB. 3CD particulars they have to take from the assessee, from the auditee, right? And non-compliance thereof, I would say the penalty is 0.5% of the sales turnover or gross receipt, maximum 1.5 lakhs. That is, even, sometimes our members feel that, oh, the due date was 30th September, we have done late audit. It is not that the penalty is always automatic. None of the penalty is automatic. Only the late fee is automatic. Friends, interest or late fee is automatic. Penalties are never automatic under any law. For that, they have to issue a notice. And in that notice, they will ask for a reason that why it was delayed. And there is a section which says if there is a reasonable cause, then the penalty will not be levied. So please don't remain in stress that last date is there. If we don't do, what will happen? Penalty would be levied. No, if there are genuine cases, suppose there is a system failure, the computers have gone down of the assessee, there are no account, and he has got the evidence, then of course the audit can only be done at the later stage. Or there is some, say, huge floods like this time it happened, or any other thing. So if there is a reasonable cause, there would be no penalty automatically. Only you have to prove whenever the notice comes. And normally we have seen the government is a bit liberal into this and not issuing the penalty notice for the smaller delays. Only in certain cases they do issue. Hence, we should not take stress of that. Now, friends, many questions have been there for the applicability of 44 AD, ADA, AB. I'll not go into questions for a simple reason that if I ask a question, you won't be able to answer. So I'm skipping these slides. But friends, just to tell you that in 44 AD, ADA, there is a slight difference. In 44 AD, if I talk about, the primary condition is that once because it is not mandatory, it is optional. So say suppose a person is starting his business, he doesn't avail of 44 AD, then he can simply, irrespective of its percentage of profits, he can file the simple balance sheet profit loss, and there is no audit required. Even the profit, if the profit is less than 6%, 8%. So please need not worry about that, and no audit is required. No audit is required. But in case, say in the first year he avails of Section 44 AD, and say in the any of the next 5 years, say in 1 year, say third year or fourth year, he opts out of 44 AD. So if he opts out of Section 44 AD, then for the next 5 years, he cannot avail of 44 AD, and he'll have to get his books of accounts maintained and get it audited. So that is the provision under Section 44 AD, subsection 4, which says if you have availed of 44 AD earlier and not availing in any one of the next 5 years, then you have to get it audited for the next 5 years. This is for the assessment year up to assessment year 25-26 or 26-27, I would say, right? And in those cases, again, you have to see that my total income, whether that is exceeding the maximum amount, no, eligible to tax, only then the audit is required. I am skipping these questions because won't be due to the system which we are having. So I'm skipping these cases. So just let us understand, because many a time questions come to me that, sir, there is a company whose turnover is 1 crore or 80 lakhs, the profit is 3%, whether the audit is required or not required. Friends, for the Section 44 AD, very simple things are there, two things, that the person has to be an eligible assessee doing eligible business. So who is an eligible assessee? Eligible assessee as defined under this section is only an individual HFN firm. No LLP, no company, no trust, no society, no one else. No one else. Only individual firm and HUF, and they should not avail of Section 10A, 10AA, 10B, 10BA or Chapter 6, Part C of Chapter 6A, that is H onwards. So if someone takes the benefit of 80 JJAA, then he is not he cannot go for 44 AD. And that eligible assessee should be doing the eligible business. What is that eligible business? Any business except that 44 AE1, the goods carriage vehicle, and his sales turnover should be less than 2 crores or 3 crores. Then various questions come that what there is a commission income, he cannot avail of 44 AD, or is having a professional income, he cannot avail of 44 AD. Yes, it is given under Section 44 AD itself that this whole Section 44 AD is not applicable to a person who is carrying profession under Section 44 AA1 or is having a commission or brokerage income or agency business. Many time a question comes, sir, commission income I have shown into the head, income from other source. That will not change the nature. The section says not only this, the 1961 Act, even the 2025 Act, if a person is having a commission income, he cannot avail. That person cannot avail of 44 AD. It is not that commission he shows separately and other income he can avail of 44 AD. No. Similarly, profession. Say a doctor is selling medicines also, and as well as having his professional income also. So for medicine selling, he takes 44 AD. For profession, he takes 44 ADA. No, he cannot take. Because if he's having a professional income, then he cannot avail of 44 AD. But yes, he can avail of 44 ADA for his professional income, And another condition is, of course, the deemed profit has to be 8% or 6% or more. Most of us, many of us, or even I would say all of us know that when it is 8%, when it is 6%. When it is through proper banking channels, then it is 6%. And if it is not, it is in cash, then it is 8%. So it could be part portion 8%, part portion 6%, both is allowed. But another important condition for the 6% is that amount to the proper banking channels should have been received before the due date of filing of the ITR. This we sometimes miss. We have to ensure that amount is received before the due date of filing of the ITR, which you say not extended date 31st July. And of course, we have to see that the profit which we declare is commensurate with the fund flow. It is not this, suppose there is a tuition income of say 2 crores. Tuition income you can avail of 4480, yes. So you deposit 2 crores in the bank and they say, okay, take tax on 16 lakhs. No, it has to be commensurate with the funds flow, right? So one has to, and another question which has come a few times, I've got a future on option income. Can I go for 4480? Why to go for 4480? Tell me. You're having the exact profit. You're having the exact profit. So please declare where the profit is clearly determinable. I would suggest my fellow colleagues that they should go for the actual things and guide the assessees in a proper way, in a professional way, right? Now, if I talk about the change which is made from assessment year 24-25, the limit increased in 44 AD from 2 crores to 3 crores. In this case, up to what limit they can avail of 44 AD? It would be in case the cash portion of the total receipts amount received from the turnover or gross receipt is less than 5%. Now there is a difference between this 1 crore to 10 crore. In 1 crore to 10 crore, the requirement is to test the total receipts. But from 2 crores to 3 crores, you have to see out of my total sales, how much portion I have received in cash. So suppose a person's turnover is say 2.5 crores. So of 2.5 crores, you have to see 5% and the cash received from that sales. If it is more than 5%, then the limit is 2 crores. But if it is less than 5%, then the limit is 3 crores. And similar change has been made from assessment at 24-25 for 44 ADA. The limit has increased from 50 lakh to 75 lakh based upon the cash basis, cash percentage of less than 5% of the gross receipts. So one has to check that. And of course, if I talk about 44 ADA, sometimes what happens is that some person says, my TDS is directed to section 194J. So I have to avail of 44 ADA. No, it is not so. Friends, merely getting the tax deducted under a wrong section or under a section particularly will not impact the nature of income. 44 AD, what is said, that who can avail first? It can be only by an individual or a firm. No HUF, no LLP, no company, no society, no trust. Only individual and firm. And they should be doing eligible profession, which is what? 44 AA1 read with the rule 6F. No other profession, please. No other profession, please. 194J TD is deducted, and that profession, that nature of income is not covered under the section 44 AA1 read with the rule 6F. They cannot avail of 44 ADA. Right? And of course, here also, the gross receipts to be less than 50 lakhs or 75 lakhs, as discussed in the last slide. And deemed profit has to be 50% or more, whatever you declare. And of course, it has to also be commensurate with the funds flow. Now, what is this section 44 AA1 read with the rule 6F? What are the professions? The notified professions, we say. These are legal, medical, engineering, architect, accountancy, technical consultancy, interior decoration, authorized representative, company secretary, there's film artists, actors, cameraman, editor, the whole list, and of course the information technology, which we talk about, the website development and others. And an accountancy here means any profession of accountancy. It could be cost accountant, chartered accountant, part-time accountant, and you need not have a professional degree to carry any of these professions. It is not mandatory that you have that professional degree. It is the nature. It is not that say a chartered accountant is running a say a restaurant and that it is a profession. No, it is not about the qualification. It is about the nature of service. Right now, friends, profession, if I talk about just in a summary, in the four sections I would talk about: 44 AA, 44 ADA, 44AB and 194J. 44AA requires about maintenance of books of accounts, and it discusses about profession in two of its subsections, though it has got 5 6 subsections, but one subsection 1 and subsection 2. Subsection 1, as we saw in our last slide, that a whole list 44AA1. This is 44AA1 and read with the rule 6F. Again, those notified profession, when they have to maintain books of accounts, this section 44AA is for maintenance of books of accounts. It says that the books of accounts is to be maintained, books of accounts is to be maintained if my gross receipt exceed rupees 1.5 lakhs. What are the books? My cash book, my ledger, my journal, in case it is an accrual business, then copies of the bills, and in case of doctors, it is my stock register and patient register. No other case, the books of records are prescribed. They are not prescribed. So when we go into my 3CD, they say books of accounts prescribed. So only for these 44AA1, the books are prescribed. For all other profession, for all other businesses, the books are not prescribed. Not prescribed, though they maintain books of accounts, and those list of accounts, books of accounts you have to mention. Subsection 2 also talks about profession, but it says profession other than subsection 1. Subsection 1. So for business and profession other than subsection 1, the books of accounts which is required is in case of individual HUF where the sales turnover is more than 25 lakhs or profit is more than 2.5 lakhs, and in other than individual HUF, what is required in my sales is exceeding 10 lakh rupees or profit is more than 1.2 lakhs. If I talk about 44ADA, only subsection 1, 44AA subsection 1, they can avail of 44ADA and no one else. No one else. TDS is directed under 194J, we say go for 44ADA, but friends, 194J also specifies, it contains my tax deduction not only on profession but also fee for technical services, royalty, independent directors fees. So even all 194J is not profession. And even the profession, if the 194J talks about, it says about all those profession which we saw in the last slide, they say, or any profession notified under 44AA1. Plus, it says any profession notified under 194J. So can there be any profession which is notified under 194J but not under 44AA1? That is, on these professionals, the TDS is to be deducted at the rate of 10% under 194J, but they cannot avail of 44ADA. The answer is yes. These are sports persons, empires, etc. And 44AB, if I talk about, of course, two clauses there. One is 44ABB, which says profession 50 lakhs or more, audit, and then 44ABD, they say less than deemed profit under 44ADA and the total income is exceeding the maximum amount not chargeable to tax, get them audited. So, right, this talks about A and D for the profession. Friends, 194J notified list is sports persons, umpires, referees, coaches, trainers, team physicians and physiotherapists, event managers, commentators, anchors, sports columnists. So these are list notified under 194J. So these are professionals, but they cannot avail of 194J. They cannot avail of 44ADA. They cannot avail of 44ADA. But these are professionals, right? So one has to be a bit careful. 44ABA, we know limit when it is 1 crore, when it is 10 crores. In case the normal limit is 1 crore and only if the aggregate of all amounts received in cash do not exceed 5% of the said amount and aggregate of all payment made in cash do not exceed 5% of the said amount, then the limit is 10 crores. And if you see clause 8A, clause 8 of 3CD, it asks about audit required under which section, 44ABA or proviso to section 44ABA. Friends, there is no audit under proviso to section 44ABA. The proviso says that in case the both receipts, aggregate of receipts and aggregate of payments are less than 5%, then this limit of 44 AB clause A has to be read as 10 crores into 1 crores. So if it is exceeding 5%, then my audit is say my payments are more than 5% cash portion, then my audit is under 44 ABA. Under proviso, it says no, there is no audit required if both are less than 5%. So please, in your 3CD, don't select the proviso to section 44 ABA, because proviso says no audit required. ABA says audit required, right? Question again, because you may not be able to answer, so I'm just skipping that. So these are the 7 sections for presumptive incomes. If we see where the profits are less than the deemed profits, then the audit is required. These 2 sections, 44B and 44BBA, the audit is not, because less than deemed profit is not allowed, so no audit. But in all other cases, if the profit is less than deemed profits, then the audit is required to the relevant provision of 44AB and the relevant sections. Only that 5-year context is only for the 44AD business. And again, audit is under 44ABE. Right? So if we just summarize the audit for the business, 5 limits, less than 1 crore, below 1 crore, 1 to 2 crore, 2 to 3 crore, 1 to 10 crore, and above 10 crores. If your assessee is having sales turnover gross receipts above 10 crore, audit hona hi hona hai. Audit is required. But if your assessee's turnover is between 1 to 2 crore, then you have to see whether he is an individual, HUF, or firm. If your assessee is neither of these 3, then go directly to 1 to 10 crore. But if they are individual HUF or firm, then you have to see whether they are taking 44 AD or not. If they are availing of 44 AD, then forget whatever is the cash, 100% cash test with 100% cash payment. And in case this individual HUF firm, their turnover is between 2 to 3 crores, then you see the sales cash portion 5%. If it is less than 5%, then if available 44 AD, they can avail 44 AD, no tax audit required. But if they are not individual HUF firm, or their cash portion is more than 5%, they're not availing of 44 AD. In that case, you have to see my receipts and payments. If both are less than 5%, limit is 10 crores. If any one is more than 5%, limit is 1 crore. Below 1 crore only in case of individual HUF and firm, and only if they have earlier availed of 44 AD. If they have not availed of 44 AD, no audit below 1 crore. Right? Earlier availing, which we have discussed earlier. Again, friends, you have to ensure that yes, financial statements are complying with the accounting standards. Our past president, Amarjit Chopra ji, also emphasized upon certain accounting standards from financial year 24-25. One has to see that this applicability of accounting standards, it is now level 1, 2, 3, 4 is not there. Only 2 levels, large and MSME. If my turnover is more than 250 crores and borrowing more than 50 crores, or borrowing more than 50 crores, then it is large. And if it is less than 250 crores and borrowing less than 50 crores, then it is MSME. So all the benefits, relaxation which are given to level 2, 3, and 4, all clubbed with the MSMEs. So one has to take care, right? And in case you are conducting an audit of MSME, please ensure that this paragraph is mentioned in your notes to the accounts of the firm, of the entity which you are auditing. It is mandatory, it's required under the, given clearly under the general instructions. Right? Accounting standards, I'm just skipping these relaxations. Yes, 18, this applicability, 250 crores, it is there for all except these 2 standards, where I would say the limits are turnover more than 50 crores or borrowing more than 10 crores. Related party, friends, just take care that the limits are the definitions are different in three different laws. AS 18 is for notes to the accounts. Disclosures, income tax 48(2)B, which we give 48(2)B, we give in form 3CD. It is only for payments. It is for payment received plus closing balances. And this too, subsection 76 is for section 184 and 188. Right. These formats, three different formats have been given by ICI for the non-corporate, for the LLPs and NPOs. Uh, use these formats because these actually is mandatory. Not skip certain slides. One important thing in the financial statements, this trade receivables, if I talk about, for a financial statements to be true and fair, one has to be very clear that if they are delayed, if there is certain cases filed, suits filed, the amounts are litigative, you cannot disclose everything to be good. Then they are doubtful, create a provision. If they are pending for more than 2 years, 3 years, how they are good? Please create a provision for doubtful debts, right? Also details as per MSMED Act, Section 22 of the MSMED Act. MSMED Act is one of the act which overrides all other laws. So those 5 disclosures also required, mandatory required. Right, I'm skipping this note. Previous year figures, as I said, framework of preparation and presentation of financial statement. If we the entity was not required to get all last year, but this year it is required. So in both the cases, if there is no material uncertainty regarding statements, then you have to state in the other matter that the previous year figures were earlier not required to be audited or were audited by any other auditor. This is as per SA 710. Please, if you are missing it, kindly do the same. Again, certain items are missing. I'm not discussing because of time. This is an important, again, 44AB, clause 8. Actually, if we do a tax audit under section A, if we issue 3CB, then we try to, but if we issue 3CA, then the audit may be due to those any four clauses, but we have to mention the third provision to section 44AB. Why? Because section 44AB says to get 2 things done. 1, books audited. 2nd, particulars to be given. Then first, second provision, third provision says, if these books are audited under any other law, true and fair view of the financial statements is given under any other law, then just give these particulars of 3CD. So 3CA does not give true and fair view of the financial statements. So in those cases, it is audited under third provision to section 44AB, right? Friends, this is again very, very important because union is also required now. But the fact is there is modified also. And this modified is for my financial statements only. Not certain disclaimers or observations which we give in for the 3CD. It is for financial statements. Now, what are these modified? Modified are of 3 types. One is qualified, another is adverse, third is disclaimer. When to give this? This is given in my SA 705. important is my materiality and my judgment pervasiveness, material but not pervasive, qualified. Pervasive, not my statement that is showing the audit is showing as yes, good. Then you have to say no, it is not good because financial statements are prepared by the management, na? And they are showing it, except that it is true and fair. But when you say my debtors, creditors, loans and advances, inventory, everything is subject to confirmation, everything is expected, no. In that case, it is pervasive. Then you have to say it is not true and fair. Or we don't get audit evidence. We cannot come to a conclusion whether there is a material misstatement or not. Because there is no audit evidence. So if a item which is material qualified, but if it is pervasive, say there was floods, vouchers were swept away, fire, all were destroyed, or all for all partnership, private limited, listed, everyone, and this is to be disclosed. Similar, if it is modified, then qualified, which when it is to be qualified, SS 705, when adverse, SS 705, or disclaimer, SS 705. Unmodified, in unmodified, again, we may not qualify, but we can give an key audit matter, which is for listed. Listed, it is mandatory, which is contained in SS 701. Right? Or we can say if it is an even emphasis of matter, then SS 706, it is unmodified, it is not and matter for emphasis for the right. Financial statements is true and fair. Whatever is given is true and fair, but certain other matters which we want to bring to the notice of the stakeholders. So when you are generating yield in this year, from this year onwards, you have to select, either you have to select unmodified and or any of these three, plus for this whether yes or no, or material uncertainty you have to give. So please tick in whatever you are saying, modified or unmodified, the verify is not able to see, the bankers are not able to see, but the data would be collected at the ICI, not person wise, but in aggregate. Right, so please do that. Again, we don't give true and fair view, but 3CD observations we give in para 3. In 3, proprietorship, partnership, LLP, they are having partnership, they are having interest to be paid to the MSME, which are not provided for. All these does not reflect a true and fair view of the financial statements. You have to give all those for financial statements in para 3. Para 5 of 3CD, that is for other disclaimers like I would say, in fact, the 269 double ST, 40A3, the we did not verification statement reporting. The union directorate would be soon coming out with the FAQ for the same. But please use SS700 reporting even in 3CB, 3CA. Just assess his responsibility, that he is responsibility for the preparation and presentation of financial statements. His statement. Mention that in para 3A of 3CB. What I say, my responsibility is to obtain reasonable assurance whether these financial statements are free from material misstatement, that where if I conduct my audit as per standards of auditing, it will always detect a fraud. I write in my report. My tax audit guidance note this year, earlier year, 2014, all said that we have to mention that in my 3CB, 3A. Wordings are there too. Again, this wording, my para 5 3CD or para 3 of 3A, assessee is responsible for 3CD. It's right in my report. Na? Please do that. Please do that. Right? ICI, the Direct Tax Committee, always have taken a call that there is a 3CD which is notified. Tax Committee, said go with the notified one. Classical example is clause 27 where they say ITC for the GST, ITC or even the Senbet credit. Though Senbet credit or ITC, so size you have to give, not in the case of GST, unless they notify the change in 3CD, only then. Right? Of course, issue a hard copy along with the uploaded copy, and don't just take a printout of the uploaded copy. Issue your own 3CD in the proper format, hard copy. This our guidance note says. Clause 16, other income, it is not about my other income like my salary or house property income in the case of proprietorship and other. No, only it is related to business. My guidance note also says that. So 194R, unbilled revenues, that you have to bring in clause 16D of 3CD. Contingent liability, only given in the notes to account to comply with AS 29, then not required to be given in clause 21, please. Also, gratuity, there are two disclosures required in 3CD. One is clause 21 and one is clause 26. 26 is for 43B and 21 is for 40A7. So please, 40A7, if there is a provision and not a payment, disallow under 40A7. If there is a approved gratuity fund and the payment is not made, then under 43B, if you make the payment before the due date of filing of the ITR, that to the approved gratuity fund, then it is allowed. So don't mix those two. And of course, it is under peer review, document yours. See the tax audit guidance note. Any point for the CP committee for inviting me to share my views. Any point which has to be taken, I can take. Otherwise, I'll conclude my discussion out there.
So there is a question
Yes,
regarding. So there is a question regarding UDN reporting. That this year the institute has started that whether you are given your opinion, whether I give yes or no. So many members are confused about it. That what kind of opinion we need to upload at UDIN.
Covered.
There are some
I've already
questions.
covered that. No? I've already covered that. No? Still, if you have any specific question, please go ahead.
No, sir, nothing is specific about that.
I've already cleared. I've already cleared because it is true and fair view on the financial statements, not 3CD disclaimers. If it is impacting my true and fair view, then I have to give. Or if it is not impacting true and fair view, I'm giving an my emphasis of matter or other matter, then I have to give. Otherwise, it is not. Now, suppose audit trail is not properly compliant, but it is not impacting my true and fair view. If it is not impacting my true and fair view, then it would be unmodified. It would depend. So if you're issuing a 3CA, in 3CA, you're not issuing a true and fair view on the financial statements because you are auditing under another law. Suppose under the Companies Act, you are auditing. It is a company. So under the Companies Act statutory audit, there it could be a modified other things. But 3CA, it will not be modified. In 3CB, because financial statements are also audited. So for the financial statements, if the true and fair view is not there, or there is a qualification or adverse, or then you have to give.
So in the new reporting model, while computing the depreciation from AS10 point of view, the non-listed entities like proprietorship firm, partnership firms, they are not doing the same. To
qualify now. Because my financial statements are not complying with the AS10. And friend, this is not due to any new framework. This is there since 1991. AS10 is this since 1991. No?
Yeah, but this year we all came to know the last member.
Yeah. I agree. But then you have to give an appropriate qualification regarding to that non-compliance.
Thank you very much, sir.
Thank you.
Thank you, sir.
Thank you.
Vishnuji is available?
No, sir.
No.
Meeting.
He's busy with the meeting, sir. So you can continue.
Okay, sir. So this is for today's seminar. I am thankful to our speaker, Sri Piyush ji, Amarjit ji, and Pramod ji to deliver the session and enlarge the audience at large. So thank you very much. We are concluding this meeting for today. Please join for tomorrow's subject at 12 p.m. For the continuation of the series. Thank you very much. Thank you very much, the CP committee, for giving me the opportunity to do so.
Thank you very much, sir.
Thank you so much, sir.